No, look, so 40...
Exorcism, is that what you're talking about?
What is it? When you're in, look, 40% of our portfolio goes into deals where we will end up with owning the majority, having operating control. And when we have operating control of a business, we're really looking, and it's been struggling with debt. It's got a business which is underinvested. For us, we are strengthening the management team. We are investing money behind the business. We are, yes, there's some cost cutting, but we are really focused on putting that good business back together. So our engagement, we have a large team of operating partners. We are really engaged with the management team and driving that change.
Hey, listen, 15 seconds, Europe, yes or no? Lots of opportunities right now.
Lots and lots.
Really? Okay.
You know she's going to ask you about that 12 months from now. So,
I was prepping last night, late hours, and I'm like, oh my God, you called it. Well done, well done.
I want to be invited back.
You will be.
Thank you.
Done deal. No doubt about it. Victor, thank you so much. Victor Khosla, Strategic Value Partners founder and Chief Investment Officer. Back to New York, and Bonnie Quinn with an update on the trade.
Carol, thank you. Yeah, we're off our lows. Still a second day of declines for equities and for yields. We have the VIX at around 25. So more companies are turning into the green. Nevertheless, sectors-wise, we're really just seeing positivity for the energy sector, really. And that includes things like Vistra Energy, which is up 4.7%. It's one of the best performers in the S&P 500. Constellation as well is up 12%. But then you had some of those earnings yesterday that are really weighing on tech in particular. Palantir down more than 12%. It is the worst performer now in the S&P 500. Speaking of which, we are waiting for earnings after the close today in about an hour and a half, roughly. We're going to be looking for what AMD says after the bell. ARM give its earnings post-market tomorrow. That will give us an idea about chip sales, the health of the AI trade before NVIDIA next week. We did, though, have an SMCI preliminary earnings report, which was not great for that company back a while. SMCI reporting tonight after the close. And then, of course, on trade, not seeing many headlines, no breakthroughs as such. We do seem to have a slight shift, though, from the administration. Meeting with Mark Carney, the new Prime Minister of Canada earlier, President Trump said he would prescribe tariff levels and tariff concessions for partners. This appears to be moving away from the idea that he's going to be in back and forth negotiations. He also said during that meeting with reporters that there would be some kind of announcement before his trip to the Middle East next week. It takes place Monday. He said the announcement would come at some point before then, but he didn't say what it would be about, whether it would be trade or investment or anything like that. So no idea what's happening there. In other markets news, we did have a solid 10-year auction, which cheered investors. And that sent yields just a little bit lower. Like I said, we have the 2-year yield now down about 4 basis points, a little more than that at 378.89. We have the 10-year yield at 431.40. The other big mover is crude oil. It's off its highs as well. A barrel of New York crude trading at $59.02 a barrel. Brent crude at $62.06 a barrel. And gold continues to rise. So let's get back to the Milken Institute Global Conference now in Beverly Hills, California. And Romaine Bostick.
All right, thanks, Bonnie. You know, Carol, I was telling you about all the great panels. I actually finally had a chance to get to one that I wasn't hosting. You have one, too.
I had one a while ago.
All right, well, there was a really amazing panel this morning here on housing affordability. And at least for me, it really hit a nerve. I think it hit a nerve with a lot of folks in the House. We talk about median home prices now approaching almost 6 times the U.S. median income. Meanwhile, if you're renting, you're spending more than a third of your income on rent, so it's kind of a weird squeeze. Last year, Airbnb formed a council of experts chaired by the former mayor of Baltimore, Stephanie Rawlings Blake, to advise the company on initiatives to boost housing supply and drive down prices. Pleased to say the mayor, Rawlings Blake, joins us right here on the Milken stage. Good to see you, Stephanie.
Thank you for having me.
Housing affordability is something people have been trying to solve probably for decades, maybe even longer than that. A lot of the topics that came up, or the responses that came up, really talked about the emphasis of more government involvement in pushing this forward. Are we seeing that?
We're definitely seeing it, but one of the things that I took out of the panel that we had is that it's going to take all of us, right? Airbnb Airbnb understands, for example, that they're not the cause of the housing supply shortage, but they can be a part of the solution. As a mayor, I knew that I didn't cause it, but I had to be a part of the solution. And some of the developers and private equity folks that were on the panel, they have to understand that they have to be a part of the solution as well. So it's an all hands on deck. You know, we talked on the panel that we're short in this country over 5 million homes. And we're not going to close that gap by doing what we did yesterday or a decade ago. We have to think critically and with more innovation around how to build more, how to build faster, and how to build better.
How does the city, though, grapple with economic growth, similar to what Baltimore went through, where you had this huge resurgence, companies coming back, people moving back to the city? Of course, that also drives up, typically, real estate prices as people look for homes. So there's a balance, right? You want to, reap the fruits of getting all those people back into your city, but at the same time, you don't want to shut everyone out who maybe isn't at a certain income level. Where's the balance?
So I always look for the win-win. And when you talk about bringing people in, that's always a good thing. But in Baltimore, like many cities, we have a circuit breaker, meaning the value of your home year over year could go up 100%, but your property tax will only go up a fraction. And that allows people to stay in their homes and reap the benefit of wealth creation through their home. But there are also things like repurposing vacant homes. I think we need to think differently about vacant homes. Yes, they're a blight, but they're also an opportunity. When home ownership is so far out of reach for many of America's young people, we can look to rebuild and these vacant homes as a way, because the infrastructure is already there, right? Cities like Baltimore were built for, over 1 million people. So that infrastructure is there, the people aren't there. So how do we look at those vacant homes as opportunities for families and young people to become homeowners?
Stephanie, I love that you went there, because I think people are like, just build homes, build the 5 million homes. It's not just about building them anywhere. It's about building them where people need them. And they tend to be cities which tend to be expensive. So as soon as the build happens, it's often expensive. How do we fix that? How do we get developers, politicians, everyone to say, let's build where the housing is needed and let's make sure we make it affordable? How do we do that?
So cities like Baltimore are incentivizing affordable housing, incentivizing repurposing vacant homes.
Right.
That was one of the projects that I started as mayor, my Vacants to Value program that our current mayor has taken on and made it his own. So we need to do things like that, where we're creating incentives like down payment assistance. The president of Johns Hopkins is speaking here at Milken. They give employees like match for match. Like they're giving their employees thousands of dollars in down payment assistance if they move around the university. So things like that. And we have to look for innovative ways to promote financing of affordable housing as well.
Do you feel like all the right stakeholders are at the table talking? Because sometimes, no. Who's missing?
I think you have to look at the job creators. On the panel today, we talked about a teacher in a public school having to commute an hour and a half, right? Mm-hmm. That is atrocious. No teacher should have to commute an hour and a half to get to the classroom. So the Board of Education should be at the table, the hospitals, the universities, all of these people, the companies, the people who are employing America's citizens should be at the table to be a part of the solution. Everyone has a different role to play, like Airbnb. Like Airbnb supports grassroots organizations that are doing things like fighting zoning laws that prevent housing, that work with cities to reduce bureaucracy, make it easier for buildings to happen across the country. That's what Airbnb is doing, their part. But every company that has employees could be doing something.
Good point.
All right, Stephanie, that was a great conversation. It was great to catch up with you. I had to fly all the way to LA to catch up with you. We'll get back to you.
Good luck.
When we're back on the East Coast. Stephanie Rawlings-Blake, Airbnb Housing Council Chair and the former mayor of Baltimore. We should also point out, she mentioned Johns Hopkins. Of course, Mike Bloomberg is a big contributor to Johns Hopkins. He is the owner of the company that owns the network that you're watching right now. All right, a lot more coverage coming up here on the big program, but we want to toss it down now to some of those great panels. Shonali Bassick actually sitting going down right now with a big panel on capital markets. Let's dip in and take a listen.
What I would tell you, though, is that the region continues to develop and create trading networks amongst themselves. So even outside of the headlines, everything that we're reading, you look at Singapore expanding its relations with its neighbors. You look at ASEAN as a whole, I think the next year or two might become the 4th largest trading bloc, if you will. You look at what India calls West Asia, or the Middle East, as other people call it. Look at it increasing the sort of trading relationships they have with the region. So Asia continues to integrate, it continues to trade. It's just the uncertainty and the overhang that we are waiting for some sort of resolution for. What I would also tell you is, you say, yes, we are a foreign investor, I agree with that, but half of our assets are here in the United States. We have had a fantastic experience with the companies here, getting to know them, learning from them. Very hard to see that changing. It is a tremendous ecosystem right here. So as we see it as a very long-term investor, we are positioned to take advantage of the volatility. We have a mandate, very broad-based, consensus-driven mandate that allows us to do that. And so in times of dislocation, we are and should continue to take advantage of the companies that we like, people who we know, and continue to invest that sort of capital for the long term. Of course, it's very challenging in any of these short-term periods of dislocation. But as has been said before at this conference, we have been here before. We have been through multiple periods that have looked far more challenging and have emerged much stronger. And let's just say you were not reading the headlines and you had come here and you listened to them.
All right, Shonali Bossack up there with a great panel on capital markets. Lots going on here at Milken, including conversations about India. India's $3.5 trillion economy still dwarfed by the $17.8 trillion behemoth that is China. Economists say it would take a lifetime to catch up. Shoddy roads, patchy education, red tape, a lack of skilled workers are just a few of the many deficiencies Western companies run into when they are setting up shop there. But there's one important measure where India could overtake its northern neighbor far more quickly as the engine of global economic growth. So let's get into it. So participating in a panel here at Milken on India's growth outlook is John Chambers. He's former Cisco CEO, today the founder and CEO of JC2 Ventures. He is also the chairman of the U.S.-India Strategic Partnership Forum. It's a nonprofit, non-governmental, and nonpartisan organization. Hallelujah, they're out there, committed to creating a partnership between the two countries. John, welcome, welcome, welcome.
Carol, it's a pleasure to be with you. Romaine, great to see you again, my friend.
Well, let's start with the environment, uncertainty. I love folks like you. You've seen lots of cycles. How do we manage through this?
Well, I'm pretty good at pattern recognition. I have a lot of weaknesses. I've seen every movie at least twice, and I've made every mistake. But all the way back to the 2001 dot-com bubble, I was the first one to call it, granted late, but I said it's a 100-year flood. The Great Recession, 2007, I called early because I saw the financial institutions change their buying behavior, and I said there's something wrong here. And even with COVID, I was unfortunately lucky enough to see it coming out of Southeast Asia before we even knew what it was about and its potential impact on the economy. Today's environment is another period of uncertainty, largely a result of tariffs. The economy was doing reasonably well. I understand the plans in front of us, but when that tariff announcement was made 2 weeks ago, first week in April, I called up all 24 of my startups and said, we're potentially headed for an economic slowdown. Here's how I want you to plan for it. Run the playbook I taught you. Focus on how you come out of it stronger. How do you control your expenses, pause for a period of time, but then how do you grow as well? So during these turnarounds...
When you say slowdown, you're talking about growth, but just slower growth, or are you talking recession?
I'm talking probably 50-50 chances of recession, and I did that the first week in April.
Okay.
I'd seen this movie, and I watched how the stock market reacted. With AI and other things, it's 5 times the speed, 3 times the output. So again, each one of my companies, I say do a plan A, which I said bordering on a recession, which unfortunately looks like it may be fairly accurate, a pessimistic plan because you want to make sure you can handle it, and then an optimistic plan for how you grow and come out of it. And that playbook I've run again and again in terms of the opportunities. The key point to remember for your viewers is technology is always led coming out of every economic downturn. So if you're betting on one industry, double on tech. You're betting on 2, AI with technology and cybersecurity. So I'm optimistic about the longer term. We'll navigate through this. Countries to bet on, to your point about India, the Middle East, Gulf states, and the U.S. are my 3 big bets.
Let me just ask you, though, do you think we're going to look back in a year, 2 years, 3 years and say, wow, this was a moment in time where the U.S. position in the global world, in global markets, changed, and maybe not for the better, or not necessarily?
Well, I think if you look at the big picture first, great question. I think the leaders in the global markets will lead with artificial intelligence, i.e. technology. As I said, they always lead us out of the economic downturns. And the uniqueness this time may be that U.S. and India work together on AI. And Modi says, you know, it's America and India together, which I kind of agree with the possibilities. So I think our countries will be stronger together. I think we'll look back a year or 2 from now and say it was an opportunity. Great companies always break away during the downturns, and great countries also respond to those. So I'm the optimist long term, but I think in the short term, we're headed for some bumps.
What would that relationship look like between the U.S. and India? Is that akin to the relationship that we maybe used to have with the U.S. and China, or is that going to be something completely different?
Oh, completely different. Just for your viewership, I was one of the first people to bet on China in a big way. I came out of Wang Laboratories. At Cisco, the first big bet I made, Carol, was bet my future on China as a partner for me. 1995, a lot of people doubted on that.
Amazing.
It was very lucrative for me. We partnered very effectively with the Chinese. They delivered on everything they committed to me, etc. But fast forward to 10 years ago. The executive chairmanship of Cisco, I lost trust in the Chinese leadership. And I moved to double down on India again. I was the first big bull in India, made my second world headquarters at Cisco in India some 20-some years ago. And I was one of the first to back away from China. I encouraged my startups not to invest in China. So I kept them largely out of that, even though I have 11 unicorns.
Do you think that has left Apple in a really rough position because of their exposure and all in?
Well, a couple things I've learned in life. Never bet against Apple or Microsoft. And Tim is wicked smart. And just like Steve was, he will know what to do. Watch how Tim's maneuvering. He'll find a way to get along with the Chinese side. But he moved his iPhone production into India. Modi realized this is a chance for his digital India to really take off. Remember, he built his whole strategy as a country around a digital India, of which digital manufacturing was one. It plays right in their sweet spot.
It's Tim Cook. I mean, you are regarded as one of the best CEOs of your time.
Thank you.
Do you think Tim Cook kind of has that crown now? Because I think about the way he navigated the first trade war during the Trump administration, this pivot that he's trying to make now to lessen his reliance on China while still maintaining a presence on China. I can't think of a CEO that's sort of threaded the needle as well as he has over the last 10 years.
I think there are probably 4 CEOs that come to mind. 3 of them are in the technology level. I think what Tim has done at Apple has been amazing. And make no mistake about it, very few leaders follow a legend that did great and had one of the most valuable companies ever. And in tech, it almost never occurs. It usually has a problem, then the company might came back. The other one I put into that is Satya at Microsoft. He is executing extremely well. The third, Jensen has the opportunity in AI that I had at Cisco, and we built the most valuable company in history. I think he has that opportunity. Then the fourth one I'd name was Jamie Dimon. He perhaps understands more than any of the leaders how do you use technology and direction. Now, one outside the country, Chandra at Tata. He is amazing what he's doing with AI and that company on so many fronts.
That would be the best panel at Milken, along with you, maybe moderating it. John Chambers, thank you so much. You are listening and watching Bloomberg from Milken.
It's great.
Great.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly. There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Baltimore so important to you?
It's our state's largest city. And if your state's largest city is not thriving, your state can't thrive. And that is just a mathematical equation, because the only way this is going to be Maryland's decade is if it's Baltimore's time. And so that's why we did focus on things like being able to extend the Orioles lease and make sure the Orioles could be here for 30 years. It's the reason we focus on things like the Preakness and keeping the Preakness in Maryland for generations to come. While we've invested in the convention center, the reason we focused on housing and getting rid of the vacant housing, the reason we focused on violent crime. And now Baltimore is having amongst the most precipitous drop of anywhere in the country when it comes to homicides and non-fatal shootings and carjackings and auto thefts. So if you can have Baltimore thriving, your state is going to thrive.
So if somebody's watching this and they're not from Maryland, but they want to know a little bit about Maryland, what would you encapsulate in a paragraph or two about what people should know about the state of Maryland?
I would say Maryland really is American miniature. You tell me what you want to do. And no matter where you're standing in the state of Maryland, I can tell you where to have a world-class experience within 2 hours. We're the home of innovation. We're the home of Johns Hopkins University, the home of the NSA, the home of NIST. We have so much to offer in the state of Maryland, and I think it's one of the reasons that people are so excited about the growth trajectory we're on.
In case you missed it, on the Pulse.
I think that the tariffs actually represent more of a disinflationary risk than an inflationary risk. You think of, for example, products coming from Asia looking for a market, them offering lower prices to find access to the market, but actually you could get trade diversion from the EU because the UK has lower tariffs. It all depends on how much substitution there really is.
Don't miss the Pulse, live every weekday.
Welcome back as we continue our special coverage of the 28th Annual Milken Institute Global Conference here in Beverly Hills, California. I'm Romaine Bostic. That's Carol Master, the host of two of your favorite programs on Bloomberg, Bloomberg Business Week and The Close. A day with markets on the back foot, a day where Jay Powell started a two-day Fed meeting, and you want to know what?
What?
Nobody's really talking about it. No one cares.
I feel like this is the year. It's so fascinating. Some of the big things and the big stories out there, all of a sudden they're kind of moved to the side because of what's going on in Washington and kind of the tariff conversation.
Yeah, probably the most important person in Washington is in the White House today. Yes. And of course, that person has had a big effect on financial markets, including in the world of fixed income. And while we have seen spreads in the U.S. high-yield bond market actually down from that big spike that we saw in early April, they do remain elevated, and so too does the volatility. And in the less liquid world of private credit, direct lending spreads do sit just a touch wider, although we don't know quite how wide for obvious reasons. But that has left some money managers much more selective about adding risk. Here to discuss those correlations and the dislocations is Armen Panossian. He's the co-CEO over at Oaktree, $200 billion in assets, mainly in credit. Great to see you, Armen.
Great to see you both.
Are you buying right now?
Carefully. We are mindful of the exposure to tariffs. We are mindful about the potential retaliatory tariffs. We think there's some good value out there, especially in public credit, but we are also recognizing the fact that we may be on the precipice of some volatile times ahead.
What are credit spreads telling us right now? We had that brief spike in early April, and I know we're still elevated, but we're nowhere near the types of blowouts we saw during past financial crises.
Correct. We're at about a 360 spread in U.S. high yield. If you look at the high and the low over the last 6 months, it was 260 and 460, so we're right in between. So you have to ask yourself, has the news been supportive of being sort of right in the middle there? I think the second and third quarter numbers as they come out, however, could suggest that 360 is a little bit on the tight side, to be honest with you.
I guess what we have to do is kind of accept the reality, though, that, all right, here we are at this moment in time, but 24 hours from now, it could be very different based on what's coming out of the White House. So when you say precipice of a volatile time, I mean, that's the reality of it. What would happen to make things settle down? Is it a tariff agreement with U.S.-China? Like, what is it in particular?
I think it's exactly right. If President Trump decides very, very soon that there is a reasonable resolution with China in particular on tariffs, then I think there's a relative calm that will persist in the economy and the markets, and companies will be able to know what to do next. For now, what's happening is there's a delay in spending, consumer spending, capital expenditures. As that continues, it could cascade into unemployment. and that's the sort of the really negative outcome here if this negotiation takes much longer.
All right, so if they get a deal, and it is a little bit more onerous in terms of tariffs between the two nations, is that kind of okay as long as we know the terms, or the terms do matter as well?
The terms do matter because whatever the tariffs are, let's say it's 60% on China and 20 or 30% for the rest of the world, that's still inflationary.
Right.
And so the question is, what's after that? And Secretary Bessent mentioned sort of a three-pronged approach. There's tariffs, there's taxes, and deregulation. So the question is, does the deregulation and do the lower taxes offset the impact, the inflationary impact of tariffs for consumers or not? If it doesn't, then there could be demand destruction and some economic issue.
So Bloomberg reported last month that Oaktree was setting up another special situations fund, trying to raise money for that. Are you able to share any thoughts on the progress of that?
Well, we can't talk about any particular fundraise, but we do see a lot of opportunity for companies in need of both equity and debt to help them bridge through uncertain times. We are seeing more activity in terms of companies calling us for rescue loans. I know others have mentioned that as well. I expect that given what's happened with the policy backdrop, and private equity firms had hoped to be able to sell out of their businesses earlier this year. It was supposed to be a really strong year for M&A. But given what's going on now, I think that those same private equity owners will have to come to the likes of Oaktree for some solutions that help to extend their ownership of those businesses.
Has there been discussion, not just at Oaktree, but just amongst your peers as well, in the private capital space about trying to find ways to increase liquidity, or at least have the flexibility to increase liquidity should times really get hard?
In terms of in liquidity in the asset class, I think that's very hard to do. Yeah. Now, the reason is in below investment grade credit or unrated credit, the borrowers want their financials to be not in the public domain. You need those financials to be in the public domain to be able to increase liquidity and transparency in the trading of those assets. In investment grade private credit, because usually the borrowers are already publicly traded, it's easy to triangulate to the value of a privately issued credit to a publicly traded company.
What are the geographical variations and differences that you're seeing, or dispersions? Europe has been a topic we've been talking about a lot here at Milken. Talk to us about that, if you would.
Well, we're not seeing a tremendous amount of dispersion yet, but what we are seeing, however, is our clients globally are wondering whether they need to back off on how much exposure they have to the U.S.
They really are asking.
They are asking. They know that the U.S. is still the best place to invest. It's the deepest market, strongest economy. But the question is, has the U.S. damaged itself in for an intermediate period with some of the policy statements we've made? And if that's the case, should we, a non-U.S. LP in particular, should we be looking at other parts of the world, like Asia or Europe? In Europe in particular, there are some tailwinds, and the tailwinds being stimulus around defense especially, and infrastructure relating to defense. A lot of capital is going to be spent. Debt to GDP in a country like Germany is low enough that there could be some additional debt taken on by Germany to fuel this type of build-out. It's probably a good time to think about asset allocations of it.
With regards to some of that allocation that we're seeing to Europe, is that concentrated, though, around defense, or at least around industries that would be a direct beneficiary of that increase in fiscal spending?
I think it's too early to tell, but I would say it's the point of focus is in general industrials, and that is a first order and second order, or it depends on defense on a first order and second order basis.
Do you think we'll see much more of an opening of the European market to private capital, private credit, private equity? They didn't necessarily chase the U.S., at least not to the same scale that we have here. Do you see the potential for that market to actually expand?
I see it. I see the potential to expand. I think the size of the borrowers in Europe, however, just tend to be smaller. The market is smaller. I don't see it becoming the size of the U.S., but I do see it growing from its current status. I think the hard part is for European LPs, for European investors, there is a different regulatory dynamic that requires them to really favor European investment, and they're not finding enough to do right now. They have a lot of capital and not enough places to put it in Europe. So the market does need to expand. ground. The question is, will there be enough businesses of size and scale and giving depth to that market for deployment in the region?
Armin, when you said that some of the investors were saying, should we reduce our exposure to the United States, by how much? Are they just saying a little bit, or are they looking to say, do I need to be a little bit more aggressive outside the U.S.?
For now, it's by a little bit.
Okay.
Right now, most non-U.S. investors have something like 50 to maybe as much as 70% of their portfolios deployed in the U.S., private equity, credit, of a variety of types. They're not talking about cutting that in half, but 5, 10, 15% could be on the table.
That's pretty significant. Hey, last question. Milken, I feel like from year to year, the mood, the narrative can change. It feels like everybody's here trying to figure out what's next. Yeah, there's always a part of that, but I'm just curious what's striking you about this year's conversations.
It's a good question. I think because the S&P is back to sort of Liberation Day levels, I'm not surprised to hear that some people are probably a little bit more optimistic than that there will be a deal cut. I'm surprised to hear that there's a belief that sort of rationality or rationalism will prevail and that we'll get to a deal on the tariff side that is acceptable to U.S. companies in a reasonable enough period of time to avoid a bad outcome. Well, I don't think that's off the table. I don't think that that's the likely outcome. And I think that the mood shifts depending on whether you're talking to U.S. investors or non-U.S. investors. U.S. investors are quite U.S.-centric, and they believe everything will be fine. Non-U.S. investors are a little bit more concerned because they are, frankly, a little bit more culturally sensitive to what our trading partners now think of us. That's a sobering kind of dichotomy in terms of conversations that I've been having over the last few days with our client base. And it gives me pause. It gives me reason for real concern that we're going to have some troubled times economically, which will then eventually create some opportunities to invest in the markets.
Well, Armin, if we are fortunate enough to catch up with you 12 months from now, it'll be interesting to see if that mood has actually changed or not. Great to have you here, Armin Panosian, the co-CEO over at Oak Tree. All right, keep an eye on public markets right now, off the lows of the day, but still in the red. Let's toss it back to Bonnie Quinn in New York, just taking a closer look at the market action. Bonnie.
Thanks, Romain. Yes, down for a second day. We are off our lows for the major indices. Nevertheless, the S&P 500 right now down more than 0.5%, and the Nasdaq 100 down 2/3%. The Dow down 0.8%. Bear in mind, though, that after the last 2 weeks run up, we're only, and I'm putting that in quotes, down about 8% from the peak for the S&P 500 and down about 10.5% on the Nasdaq 100. Of course, we're waiting on some seriously important earnings for the Nasdaq 100. Later on, we're going to hear from ARM, and we're going to hear after the closing bell from several other companies too. We'll get an idea of what chip demand has been like, and that'll give us a signal for what NVIDIA's earnings might be like at the end of the month. We're also waiting on trade headlines, AMD after the close, as I said, ARM tomorrow, and other companies like Rivian as well, which will be an interesting one after the close. It's up 28% year over year, basically unchanged year to date. But earlier, we had Speaker Johnson saying it does look like the EV tax credit will be killed. Towards the end of this week, the Republicans are going to take that to the House. We did have a solid 10-year auction, but if you look at the curve, it is lower. We have the 10-year yield down about 4.5 basis points. The 2-year yield down about 4 basis points at this stage. Solid auction at the same time, good demand for those 10 years. And then a couple of notable movers. Constellation Energy shares surging. It's up about 12% after announcing it's close to signing long-term deals to provide nuclear energy to meet that growing demand from data centers and factories. So perhaps someplace else where the power can come from as opposed to natural gas or coal. Palantir, though, down 12% after its earnings didn't sufficiently prompt fresh aggregate buying. Let's get back to the Milken Global Institute conference now in Beverly Hills, California, and Romain Bostic. Romain.
All right, Romain Bostic here, along with Carol Master at the Milken Global Institute. I'm pointing to you. That's a loving point there. All right, let's get right to it here, because we got a great guest standing by. We're going to talk about global wealth, because global wealth assets held by individuals, when you add all that up, with a calculator,
it's a lot.
That actually rivals the pool of capital that you actually see, believe it or not, amongst institutions. And that pool of capital, as that grows, private markets are becoming a much more critical replacement to some of the public-facing portions of that, as well as equity allocations as well. Alternative investment firms like Apollo have really leaned into that, led by the efforts of none other than Stephanie Drescher, the firm's Chief Client and Product Development Officer. Pleased to say that Stephanie joins us right now. Stephanie, great to see you.
Great to see you. Thanks for having me back this year.
Absolutely. What are you hearing from clients these days?
You know what? You just have to look at the volatility that we've all experienced year to date to recognize that they are looking for the alternatives, as you just mentioned, to supplement, to replace a portion of their public equity exposure. Given the increasing volatility and correlation that we've all experienced, it's resonating in terms of what the private credit markets, private equity markets, real assets can offer in their overall portfolios. So our phones have been ringing.
This may be a dumb question, but is there enough to go around? Like, where are the opportunities right now? Because it seemed like even before this year, there was so much competition for what at times seemed like a relatively limited pool.
You know what? We thankfully have built out that proprietary origination, and while we have developed extensive relationships with financial firms, we also have created our own engines to create those opportunities. So origination is critical, and investors, individuals and institutions alike, are seeking that. So we feel really good about the opportunities we can offer in addition to the public exposure that our clients have. But ensuring that that type of excess return is generated from all those sources of underlying kind of proprietary flow is critical.
But playing off of that, I do think about, as certainly the private markets have to continue to grow, and there's just so much money chasing again certain deals. You know, should we assume at some point there's some distortion, or how do we prevent, or how do you guys make sure that there isn't that distortion in the market when it comes to valuations and investing?
Look, we believe that the promise of, quote, alternatives, really the private market exposure, is to deliver that excess return per unit of risk over the public market equivalent. And having that discipline, having that rigor of analysis to make sure that we deliver on that incremental return, albeit for slightly more illiquidity, is critical. So our view is to maintain that discipline. Not all managers are created equal. Yeah. It's why selection is critical, and ensuring that there's that trust with the managers in your portfolio.
Is AI helping you guys in this analysis? I am just curious how that's kind of being factored in.
Right. Look, as a firm, we're clearly looking to AI to make us more efficient and to ensure that we're taking advantage of the developments in AI application. I think there will be more for us and for the financial community as we go through that to complement the judgment that we have as investors.
Are you doing it already?
Yes, we've started to incorporate different use cases into areas where we feel we can build out that efficiency to support our process. It's certainly not a replacement for the investment judgment that we bring to bear. I just wanted to mention earlier, you highlighted the kind of the scope of opportunity for individuals, and it does equal the size of the institutional market. And over the last year, there's been so much progress made in terms of the innovation and ability to deliver products for the individual, for families, as they frankly deal with the realities of the 60-40 portfolio.
Well, that's what I'm curious about, too, because back in the last big investor day you had, I think it was in October or so, you guys talked a lot about growing that wealth channel. I think the target is $150 billion by 2029.
Right.
Where does that come from? Because I know you've made some partnerships. Apollo has made partnerships where you're bringing in investors that are less high net worth, or at least you're offering products that are more accessible at a base price point. Is that the strategy?
That's part of it. When we think about the market opportunity, it's everything from partnerships with private banks and wires to those in the independent channel, the ultra-high net worth family office, as well as partnerships, as you're referring to, for the mass affluent. So there is a wide range. It all goes back to making sure that we can help the families and individuals to achieve their retirement goals, their kind of wealth and retirement objectives. And today, it's harder than ever, given the the traditional public 60-40 performance. Even year to date, that's down about 1%. So given the volatility and the indexation that we see, increasing correlation, the ability to supplement that public exposure, equity and debt, with private holdings has been a very prominent part of our conversations.
I am curious in terms of the administration. I'm not going to ask you to say anything about tariffs right now, but in terms of regulatory oversight to one of the things that we are talking about, democratization. Again, I'm thinking about that. The 60-40, not so great. I'd love to have more access, but I'm just curious what might come down from the White House and the administration that helps in that pursuit.
You know what, we'll see. I do believe that there's recognition that the institutions have benefited from these excess returns in their portfolios for decades. And it's real in terms of the ability to help historically retirees through pension plans, save and build. And I do believe that over time, there should be the same access for individuals as we think about their pools of capital.
We'll see what happens, right? So much going on. Stephanie, thank you so much. Thanks for coming by once again here at Milken. Stephanie Drescher. She is Apollo Partner and Chief Client and Product Development Officer right here on set with us. Hey, happening right now on one of the stages here at Milken is our own Sonali Bostic leading a panel on capital markets 2025. Let's listen in.
Look at my energy price, because energy is a big input in most production. What, if do I need to hedge, or, is it kind of lower for longer? And then the same thing with the dollar weakness. Is this my time to lock into kind of, the dollar rates? Because, this is after a long time, you're seeing that kind of dollar weakness kind of linger for a while. Then the other question is, are rates going to be higher for longer? Because, and we talked a bit about it on the adjacency. So if you look at that, U.S. debt, you got what, 30 trillion or thereabouts, government and corporate debt. And a third of that is held overseas, to your point around, U.S. assets. So you have on that roster, you have, Japan, China, and the UK, and a whole bunch of nations holding a big chunk of that debt. And the question is also, as that debt, clearly, Jim, your point around, nobody's selling, there's no kind of, there's no dumping and the like, there's no evidence of that. But you also see gold is kind of lingering around, 3,500. So somebody kind of flipping and reallocating portfolios. And the question is, if a lot of the traditional buyers, because they're offended, upset, stop buying U.S. debt the way they used to, what happens to the long bond and what happens to the yield curve? Because to sell it going forward, you have to pay up. So the question is, do yields stay higher for longer? So there are a whole bunch of kind of, moving parts, which once again, with a bit of prudence, the key is to maintain, liquidity is, you have to maintain liquidity. We've seen this story before. And when liquidity dries up, then folks start selling the good stuff because that is what is saleable, and to make up for losses on the bad stuff. So I think we're advising clients, stay liquid, be very, very prudent, capital structure clean. Incredible opportunities will come up because when there's corrections.
All right, everybody, of course, that's Sonali Bostic up on the big stage here at Milken. Now, we are headed to the close here on Wall Street, just about 15 minutes to go. With us right now, though, is a great voice to talk about the market environment, really the big picture. Let's bring in Mary Pang. She's Cambridge Associates Global Head of Client Solutions and a partner as well at Cambridge. They help institutional investors, including endowments, foundations, and family offices, invest their capital across a multitude of asset classes. And they had about $616 billion in assets under management. That's as of the end of last year. Mary, great to have you here with Romain and myself. Big picture, a lot going on, a lot of questions here at Milken. How do you see it, and how much clarity do you feel like we have about what's to come over the next 6 to 12 months?
That's a great question, Carol, and thank you for having me on the show today. Well, there is certainly a lot of uncertainty that's going on in the marketplace right now. A lot of the families that we talk to, ultra-high net worth families, ultra-high net worth principals, are asking us a lot of questions around the uncertainty that seems to be facing them in their portfolios, particularly in the U.S. The one question that typically comes up in some of these conversations with our clients globally is whether the U.S. is actually still a safe and reliable place to invest. Listen, we're not in the business of trying to catch...
Have you ever been asked that before?
Not so as much as we have been lately, that's for sure. Particularly given our clients are all overseas, many of them are overseas, and a lot of international clients have been asking us that question. We're not in the business of trying to catch a falling knife here. We're in the long-term business. We're basically trying to provide our clients with a sense of calm and give them the advice to stay the course and just to be very diligent about their commitment options.
But there is I mean, I know the short-term noise isn't what you get involved in, and you have the luxury of being above that. But there are things taking place now that some people think are going to be long-term structural changes to the global world order, for lack of a better phrase. When does that enter into how you think about things and how you think about the advice you give?
Yeah, no, it's a great question, and I think there's definitely short-term pressures across every single asset class that we have to stay on top of. We're talking to our managers every single day. We want to stay on top of exactly what some of these pressures are and how that's going to impact our clients at the end of the day. I mean, yes, the world order could change, business models can change, and that can affect all of our clients, not just family offices, endowments and foundations, insurance companies, all the funds and pools of capital that we represent. So we're in a little bit of a wait and see. I mean, I think there's a lot going on right now, right? So we just want to wait for that sense of calm to come.
I am curious, though, just to stay on the geographic issue, and I understand why people are scared of the U.S. right now.
Yeah.
I'm scared of the U.S. and I live here.
Right.
But what about China? Because that was a big narrative for the last few years, that people were pulling back from China, primarily because of the adversarial relationship between the U.S. Are you seeing more interest, though, of folks wanting to go back in?
I would say that there's not an increased interest in China right now. People are just staying the course, I would say. Some of our family office clients, for example, are exploring geographic diversification, so out of the U.S. into places like Asia, but more India-focused, actually, and the Middle East. And they're trying to find opportunities to take advantage of that.
You know what's kind of interesting is I feel like we are constantly questioning kind of this 60-40 and why we need to let everybody kind of have more access to the private markets. Are we at this moment are slowly building towards it, or rapidly, where the public markets, I don't know, I guess they don't go away, but what happens? No, I know this is our bread and butter, but I mean, I'm just wondering where everybody's saying that increasingly we're seeing more activity, in the private markets. Did I give you a heart attack?
You did.
But do you know what I'm saying? Like, it's just interesting.
Yeah, no, absolutely. It's a great point, Carol. I mean, I think the way that we talk to some of our big ultra-high net worth family clients, for example, is to think about long-term returns, right? There's always going to be short-term noise, and we will have to manage through them. But the portfolios that we build are deeply rooted in long-term vision, and it's to insulate and help protect some of the volatility in the markets.
But to her point too, haven't we seen? So in terms of total portfolio, the holistic portfolio, it's kind of more of a blend of public and private in a way that we didn't have, when I started my career, for example.
Yeah, no, absolutely. But when we talk to some of our clients, they have very, very large allocations to privates now, 40, 50%. Sometimes in the case of family offices, it's a heck of a lot more. So, there's a lot of dynamics that are changing in the private investment market. You were talking to some of your guests around the democratization of private investments, and that has an impact on the dynamics of how we should allocate capital on behalf of our clients. So we have to do the extra due diligence, talk to our managers. That's one of the reasons why we're here at Milken. A lot of the managers are here, and we want to make sure we're asking the right questions. Who is your capital base? Who are your investors? Are they long-term investors? Are they aligned with the families that we serve?
See, I gave you a heart attack, but she said it was a good question.
I know. Thankfully, she ends on a high note.
You.
So thank you for being a ray of optimism. Mary, great insights as well. Mary Pang is Cambridge Associates Global Head of Client Solutions. As we are here on the Milken stage, we're just getting started. We got another hour and a half to go
in our
15
coverage. Minutes away. We're not.
No, we're not, Carol Master. You might be leaving. I'm staying, and a big part of the reason is our next guest coming up at the bottom of the hour, Manny Roman, the CEO of PIMCO. We're going to get his thoughts on a wide range of things, the economy, bonds, and everything in between. Don't go anywhere. This is Bloomberg.
In case you missed it on the opening trade.
The president is speaking to this part of our population that we know did not benefit from globalization. The IMF has been talking about those left behind for decades, and we haven't really seen anything to speak to that part of the population. That's who President Trump is speaking to. But we in Europe, we're seeing the same thing. We're just a few years behind. That part of the population who were left behind are voting, they're speaking, and this is going to unpick a lot of the fabric of the economy that we have seen for the last 20 years. So for me as an investor, it's really thinking about, right, if we had 20 years of globalization that created winners and losers, who were they? And if this is going into reverse, maybe the past losers will be the winners, and maybe the past winners will be the losers.
Don't miss the opening trade, live every weekday.
The top names in business are on Bloomberg.
The policy actions to date have raised the level of uncertainty to a degree that I don't think is healthy for investment and growth. It's going to be important that we get more clarity on the direction of travel from here. As I'm talking to CEOs, as I'm talking to our clients, they are holding back on investment, and they're certainly tightening their belt. You're going to see some companies laying off employees and running their businesses tighter because of this level of uncertainty.
Nobody covers business like Bloomberg.
What's the best thing and what's the worst thing about trying to put money to work in this market?
Technically, we're an endowment, but we use the best of the endowment model and the hedge fund model so we can react very quickly. And I think we're very good, I would argue probably one of the best in the world at connecting the dots across asset classes. And from our perspective right now, the volatility is great. I think market structure is still challenged in that liquidity at moments in time when there's a lot of volatility is challenging. So you can see a great trade, but sometimes buying as much of it as you want is easier said than done.
Do you have a favorite trade right now?
So we are tactically, at the end of last year, we bought call spreads on Hong Kong equity indexes. And I continue to like that trade, so we're holding that position. And again, when you see kind of the micro and macroeconomic data coming out of the U.S. and you see the data in China, I think you will see a tactical deal out of economic necessity between China and the U.S. And I think when you look at investors generally, they've left China for dead. So I think there's going to be money forced into that market.
Season is here.
Earnings season begins. Is corporate America in a good place?
Wall Street is bracing. Bloomberg is first to break the numbers.
We got Delta, Constellation Brands.
The wave of big tech earnings.
We've seen a re-rating of earnings estimates.
I got to pay special attention to all this.
With the smartest insights.
Given the degree of uncertainty, you haven't really cut earnings estimates that much.
Anyone who says they have certainty on where the growth outlook is going, where earnings are going, is probably exaggerating.
Continuing coverage on Bloomberg.
Welcome back to our live coverage of the Milken Global Investment Conference here in Beverly Hills, California. I'm Romaine Bostick.
I'm Carol Masser. Welcome, everybody. We've got a lot coming up in the next hour and a half.
A lot coming up in the next hour and a half, and let's get right to it. We've got a lot of great guests here on the Milken stage, and right now we want to bring in the head of the world's biggest active bond manager, PIMCO. They began earlier this year, making a case for actually owning treasuries in that 5 to 10 year zone as it saw, get this, unpredictable U.S. policy furnishing the appeal of high-quality bonds, at least compared to equities as well as to corporate debt. And so far, that bet has paid off. You see that in the returns in the bond market relative to equities. For a closer view of that market and the signals it may be sending, pleased to say that Manny Roman joins us right now, CEO of PIMCO. Great to have you, Manny.
Thank you for having me.
Market disruptions, market perceptions have changed a lot, really in the last 4 months, because I felt like in January, coming into this year, people were relatively optimistic.
That's correct. I think people had made the assumption that there'd be a very quick resolution to the tariff question. And the reality is there's a lot we don't know, but that tariffs are going to be high and that we're going to have to deal with it for a long time. And that we'll need to readjust our thinking, both in terms of economic growth, but also inflation. And I think that's the real question we have to deal with.
Can you make that change now, meaning like when you have to factor in what economic growth will be, what the impact of tariffs will be, even though we don't know How do you make that pivot now?
I think you do scenario analysis. The big three trading partners are China, Mexico, Canada. So you basically run simulation and say, if this happened, then this will be GDP. If this happened, this will be inflation. And acknowledge that we don't know what the end game is going to be. And the only thing we can reasonably say is the overwhelming likelihood is you will have high tariff for the foreseeable future. And we'll have to deal with this.
Manny, once we know what the terms are, does some of the uncertainty go away and things settle down? But it's structurally a different financial dynamic potentially, depending on how high those tariffs are?
I think that's right, but I think a number of companies will have to re-engineer the supply chain and optimize the production costs and the transfer pricing based on what the tariff will be. And I think that changing supply chain may not be as easy as what you make it to be. For us, we look at a set of macro parameters and optimize our portfolio and decide what we think is attractive in terms of asset and buy them at the best possible price.
So what does that mean for investors? Do they just kind of stay put, waiting for everything to settle? Or are they starting to make those bets, assuming it is going to be very different? Tell us a little bit about what you are seeing in terms of flows and so on.
I think you've seen enormous volatility in the equity market.
Right.
And somehow I would say we're surprised that the equity market has bounced back to the Liberation Day level, but you've seen clearly a move to cash. Our world, which is the bond world, has been pretty much unaffected. And my partner, Dan Iverson, has this say where you look at the yield on a portfolio of bonds, say 6%, 6.5%, it's a very good predictor of what your return will be over the next 5 years. So if you want to own bonds, you're going to make 6.5%, give or take, over the next 5 years. How are you going to get there? A lot of uncertainty.
Well, that's what I'm curious is about the volatility. And I mean, you're referring to your CIO. I mean, I saw an interview where you actually talked about how he was really embracing that volatility to a certain extent.
So there's two components to it. What we like about volatility is the fact that it will provide investment opportunity and a source of alpha in terms of trading different part of the curve, but also different product, and to move away from the US and find opportunity in other part of the world. So you can always buy US asset, but you can also buy non-US asset as a way to get duration and hedge them back into dollar. So for example, we like Australian duration. Australia has a very robust economy. We like Australian bonds, but we hedge them back into dollars.
Yeah.
That's a way to add alpha to the portfolio.
How complicated is it to do that when there's also a ton of volatility in the FX space and no one seems to know where the dollars might be going?
You may wonder what the 2,000 people we have in Newport Beach do. That's what they do. You know, we could deal with that. Just about, but we could deal with that.
Listen, U.S. Secretary of Treasury Scott Bessent obviously really kicking off Milken on Monday, and he talked about the importance of watching the 10-year. Do you agree in terms of U.S. Treasuries?
The cost of borrowing is very important, and I think I will answer this in twofold. One, the U.S. dollar as a reserve currency is really important, and the 10-year bond is in a way the barometer for the financial health of the world economy. So it is really important. Now, I would say you look at the whole yield curve. You look at the short end, the 10-year, the 30-year. You think also about credit spread. They're very tight. And you think about all of these parameters and try to assess what's to come and how you're going to deal with it.
Manny, one thing I'm curious about, and bringing up Secretary Bessent, what is the voice that you listen to most in trying to determine ultimately what happens in the U.S., especially when it comes to its financial system and the importance of, you know, it's been the place, the world's safe haven, right?
And it will remain as the place of safe haven.
You're so sure. Why?
Well, think about it. The U.S. dollar is the reserve currency, but it's also the most liquid treasury market in the world by an enormous factor. And yes, you know, you can make a reasonable argument that the dollar is slightly expensive and that you may want to diversify from the dollar to other currency, but it does not mean that the dollar loses its status. And I think it's very important to keep that in mind. There's no other reserve currency. There's no other place to move trillions and trillions of dollars away from the dollar. And it is what it is.
Do you have faith in the Treasury Secretary to do the right thing, or at least get the president's ear on doing the right thing? Because he has said some things in regards to the Fed, the Treasury Secretary even. So I'm just curious, do you have faith?
I think the wonderful thing about financial markets is that they're efficient. And
so they'll tell them.
And that the market reacts to policy. Yeah. And when the market doesn't like either policies or a tweet, the market reacts in such a way that people need to adjust the course of action. The market wants the Fed to be independent, and I think has voted very strongly about that. And I think that dictates some of the choices and some of the noise around all of this. And, you know, it's a good thing. Markets are there to reflect supply and demand and also reaction to events in the world.
And we saw that play out in a big way in April. Well, one side of that, though, but basically to your comments about their kind of this being the most liquid market, this is kind of the reserve currency, and that's not going to end. Will it lessen to a degree? Because when we look at our treasury market and we think about how many global investors hold our bonds, all the rumors that maybe certain nations might be willing to weaponize their holdings if the dispute with the U.S. over trade escalates, does that concern you?
You know, there's no free lunch. The reason why people own U.S. dollar is because they like to own U.S. dollar asset. There is a very strong case for American exceptionalism, the fact that the financial systems are very liquid and very well run, and that if you, for example, a Japanese investor where there's about $1 trillion of U.S. debt held by a Japanese institution, it's a good place to be, even hedged back in yen. And I think that's really an important fact to remember in terms of the flow of funds and who needs to put money where.
Is the Treasury market healthy right now?
Totally.
You weren't concerned at all about what transpired that first week of April, about a potential gum up in the system or that mismatch between buyers and sellers?
No, on the contrary, I think we've seen very liquid market, both in Treasury and in credit. And to be honest, you know, markets have been remarkably well behaved. Yeah. We had a couple of difficult days during COVID before the Fed intervened, but it's been very smooth sailing since. And you know, the markets offer plenty of opportunity to change your mind. One of the good contributions have been ETF, where ETF have allowed people like us to do portfolio trade, to rebalance our book, and to use this liquidity to move assets around. And I would really emphasize this: the markets are quite liquid.
I promise not all my questions are pessimistic, but I do have one more. With regard, I mean, you had a market that had to deal with the trade issues. That hasn't been resolved, but they certainly made some degree of peace with where we are. There's now a big budget battle that's about to take place in Washington. And I do wonder, as the leader of the biggest bond company, bond investor out there, is there concern that our fiscal deficit and the potential remedies that are being discussed in Congress could exacerbate the situation in the fixed income market?
That's the wonder of being the reserve currency. Everything else being equal, you can run a slightly higher deficit than you would otherwise. And I think that, of course, people will look at the amount of deficit and you know, it is overwhelmingly likely that the deficit is not going to get reduced. But once again, would you rather own very high quality assets in the US, or would you rather own bonds in Southern Europe? You can decide which one you would rather own. That's the reality. The reality is you need to invest somewhere.
So you're not worried about, it's a lot of debt. fiscal situation. It's been a lot of debt for a long time, but now we're at levels we haven't seen. And so I'm just curious, is there some point, it sounds like you're saying, well, where else are you going to go, right? And it's kind of part of the U.S. being the market in the world. So, like, should we just accept it?
No, I think I would reply with a quote that I heard Janet Yellen give in a private conversation. Yeah. She said, all we can say is it's not a problem until it becomes a problem. And so, but it's a deeper meaning maybe that it appears. Like there's a tipping point, which is very hard to guess, where all of a sudden, either because the issuer loses credibility or because the policy doesn't make sense to market participants, people all of a sudden don't want to be the marginal buyer. And I think that's the analysis we constantly make in terms of what's the right level to clear the market.
Manny, when we had the disconnect between the equity market selling off a bunch and we saw yields spiking, right? We were trying to make sense of it, right? It just didn't seem to come together. Are you telling investors, watch the bond market? Equities kind of do, like how do you make sense of something like that?
Well, you could say that it did make sense because the market all of a sudden said, we're going to get in a worst possible situation. We're going to get into stagflation.
Right.
And in a case of stagflation, I can remember 73 and 74. Now, there were real macro reason with an oil shock, but stagflation is a real ugly problem because everything goes down. Yeah. There's no place to hide except cash. And even cash, because of inflation, you lose money. And I think you saw the price of gold reacting to this. And so if you use my frame of mind, then I think it sort of makes sense. It's not a pretty picture, and I think the market corrected pretty quickly and said, you know what, stagflation is by far not the most likely scenario, but the odds of a recession must be slightly above 50.
Do you agree stagflation not likely?
Yes.
You agree it's not likely? Okay.
It's not likely.
Got it.
And I think stagflation is the nightmare of all central bankers.
Yeah.
And most of them haven't seen it. You know, you have to remember that market participants, there's only one good thing about being old, is you've seen market cycle.
Yeah.
And, you know, I remember, for example, the 91-92 crisis with the SNL, you know, we had the Milken conference, you know, people had bought a lot of high yield debt, and some of it had to sell. So you remember that. You try not to make the same mistake. You remember 1998, you remember 2001 and 2002. And of course, you remember the great financial crisis. And each crisis is different, but you have a frame of reference where you've seen ups and downs in the financial markets.
I want to talk specifically about your business. And I mean, you've got a big private credit business alongside the public credit business. And we've been talking a lot over the last couple of days about how all these markets seem to be overlapping. There's sort of this Venn diagram between public markets, private markets, credit, equity, et cetera. Are they in conflict with each other, or are they complementing each other?
I think they complement each other, but they may not offer the same value at every point in time. So I'll give you a very simple example. There's a reasonable case to be made that we have a probability of a recession slightly above 50%. If that's the case, you don't want to own high yield credit, and you probably don't want to own direct lending. Why? Because the company are leveraged, they are weak single B, they may or may not be in the industry you want to be in, and so if you have a recession, you'll see losses. By the way, losses are normal. It doesn't mean there's anything wrong, but when we think of optimizing our portfolio, we find better opportunity to invest than the weaker credit at this stage of the business cycle.
And in making those decisions, I mean, you referenced just a second ago about all the folks who have to figure out where the dollar's going to go. I assume that there's got to be a big technological component to that. And when you took over back in 2016, you made a big push to add more technology resources to what you guys do. And given what's transpired over the last few years with AI and the newfound interest in that space, I'm wondering how much of that has become a component of the analysis and decision-making process?
A very large one, and that's a very good question. If you think about it, you know, what do we want? We want great people to work for PIMCO and to stay for as long as possible. And then we want the best technology and the most innovative quant, and marry the two together, and hope that it works. And the AI revolution for us is the ability to manipulate a lot of data coming from very disparate sources, analyze them, and get to a tool to help making decisions, which is incredibly granular. So we are a very, very big player in mortgages. Everyone has a mortgage somewhere. Yeah. We have a totally unique database. And what I mean by database is not only numbers, it's picture, it's location, it's conversation with the mortgage broker. And so you get an edge because you have an ability to crunch through an enormous amount of data and get to another granular level of decision that our human brain would need longer to be able to do.
His would go pretty quickly.
No, yeah,
I'm just going to tell you.
He's very fast.
He's very, very fast.
I heard.
Manny, so thoughtful, so helpful. Thank you so much for us and for our audience. Really appreciate it. Manny Robin, the PIMCO CEO. All right, just got about 13 minutes left to go in the trading session. Back to Bonnie Quinn in New York.
Carol, thank you. Yeah, just a few minutes left. We are waiting for earnings after the bell, but let me tell you that we are seeing a little bit of buying in the run-up to the last quarter hour or so of trading. The S&P 500 now practically out at session highs, down 0.4% nonetheless, and the Nasdaq 100 down about 0.5%. It's still the same leaders and decliners. We have Constellation leading up about 12% and Palantir on the decline by about 12%. Some new headlines for you. Canada's new Prime Minister Mark Carney, of course, has been talking to President Trump today. He held a news conference after the meeting saying Canada will have further conversations with the US in the coming weeks, particularly at the G7 meetings. Now, they are taking place in Alberta, Canada, mid-June, so that's just about 5-6 weeks away. Carney told reporters, "I think we established a good basis." He said the US and Canada both want to move forward with trade talks and that he discussed auto industry competitiveness with Trump. He also said he made the case for Trump to remove fentanyl-related tariffs. Now, the Canadian dollar had been stronger and continues to be stronger versus a US dollar index that's weaker now by about 2/3 of 1%. Back to the Milken Global Institute conference now in Beverly Hills, California, and Carol Masser. Carol.
All right, Bonnie, thank you so much. Bombardier ADRs that trade in the United States, they dropped as much as around 9% last Thursday. This is after the Quebec-based jet manufacturer's first quarter numbers came out. Their adjusted earnings, EBITDA, and revenue did miss analyst expectations. The company also reintroduced its 2025 forecast, expecting adjusted EBITDA for the full year to reach above 1.55 billion, I should say. Keep in mind the ADR is down about 10% year to date. With more on the company's business, where we are so delighted to have with us Eric Martel. He is the Chief Executive Officer of Bombardier here at Milken. Welcome, welcome.
Thank you.
Tell us about the experience here at Milken. I'm just curious how many people are saying, talk to us about your global supply chain.
We've been here many years, actually, at Milken. We're doing this every year. We have a lot of our customer here, so it's an opportunity to have conversation with our customer. And so this is a great conference. There's a lot of interesting topic, I would say, we discuss these days. So we are happy to be here again for, I don't know how many times, stop counting.
Well, but what's great about talking to someone like you or someone who's really leveraged the supply chain across North America. And I'm curious, what are some of the lessons that you've learned from building that out that maybe you could share with other folks who are looking at, maybe I've got to do it, but it looks like it's just insurmountable?
I think in the early days of COVID, I would probably talk about fall 2020, we've made a very different decision at Bombardier. Instead of cutting people in supply chain, we added people, which was very different than the normal crowd. So I think that's what explained probably our ability to better forecast over the last couple of years the number of airplanes we're delivering. So we have a very proactive approach, trying to see problems coming up like 18 months before they come so that you have time to sort them out. So it's been serving us pretty well. We're not perfect. We still have things sometimes that come out at the last minute. But so far, we've worked very diligently with our supplier base, which we have 5,000 suppliers total, so which brings some complexity. But it's been going fairly well so far.
What's demand like? And let's start with the airlines first, that side of the business, because several of the big carriers, not necessarily the ones that use use Bombardier jets, have basically said, look, things are going to be a little slower than what we thought in terms of passenger travel. Have you seen any real ripple effect of that down to the types of jets that you sell?
Yeah. So as you said, we're focused on business aviation, so we just do private jet. But clearly, COVID was an accelerator for our environment. A lot of people, you know, go back to 2020. In the summer of 2020, a lot of commercial flights were grounded. You know, a lot of liaison did not happen. So the people who could afford it maybe didn't buy their own airplane, but they bought shares, you know, from fleet operator and hours, and started to fly private. So we've seen an explosion of hours. If I look at the hours our jets were flying in 2019, today it's about 40% higher. And it's the new normal. It's been going up another 3% since last year. So clearly our business, it created a new normal of activity. And since then, it's been just growing, keep growing.
So what ails the airlines does not necessarily affect your company, your customers in the same way. They're
we have a different customer base. You know, the people that buy our product are chairman, CEO. Either they have a company in the U.S., so they will use a smaller jet, or they have a global company. And I don't know, they're in New York today, they need to be in Singapore next day and come back to Dubai 3 days later. So these guys, it's a very efficient tool for them. You know, they would never be able to do that flying commercial.
Can I ask you about the new 8000 jet? Is that going to enter service this year?
It is, actually. So we stopped flying the airplane now. We flew the airplane. We have all the testing done. Now we're working with the authorities, you know, on engines, you know, with GE, because, you know, most of our customer base, supplier base, is in the U.S. 2,800 supplier in the U.S. And we are working with all these guys to get the 8000 certified by year end. We're pretty excited because this is going to be the new flagship of the industry, the biggest airplane in business aviation that flies further, faster, higher than anything else that exists today.
Wait, so I'm just curious, going back to business jet orders and companies and their environment, are you seeing orders fall off from companies at all that as a sign of holding back?
Yeah, Q1.
Because it is something that, like, I think we're looking for different indicators, like when it comes to what's the health of the overall outlook in a world where, certainly at Milken, everybody keeps talking about uncertainty.
Yeah. You know what? It was very similar in the first quarter to what we saw 2 years ago when we had the bank crisis. About 3-4 weeks of uncertainty. And, you know, we assembled the airplane in Canada, so there was question about the tariff, how is it going to work? There was a bit of lack of clarity. But as things clarified around the quarter, we've seen things re-engaging normally. So right now we have quite a bit of activity, you know, here this week, but also, you know, worldwide. I would say Middle East is very strong. APAC remains pretty strong too. Europe maybe a bit more slow, but the U.S. is doing fairly well.
Eric, one thing I want to ask you, President Trump meeting with the Prime Minister of Canada, Mark Carney, USMCA came up several times, and the Prime Minister stressing, you know, the importance of that agreement. I am curious what kinds of opportunities that integration specifically has provided you guys.
Yeah. I think if
is it a good trade agreement for you?
It is a good trade agreement already, and I think I understand exactly the President of the United States wants to revisit that, and I think our government would be fine doing so. I think it's been a huge leverage for the three countries that are part of the agreement over the years. Actually, aerospace, even before NAFTA, in 1979, we had a free trade agreement worldwide. And I think there's in aerospace, you know, of course, we assemble, we're being perceived as a Canadian company, which I'm extremely proud of, but we are really a North American company. I have 2,800 suppliers in the U.S., 2,800. And many in Mexico also, many in Canada. So overall, we've done extremely well all together. It's a great business, but it's important. You know, this is not something we can change overnight. It's going to have to take time if we want to move things around, bring back work into the U.S., which we still have a lot today. And it's interesting, despite being Canadian today, I have like, if you take the Global 7500 today, 42% of all the cost of the airplane is U.S. So, because we do build a wing, which is one of the most important components here in Dallas, and we also buy the engines from GE in Lafayette.
Right, exactly. So if he wants to buy, what is it, the new 800?
It's 8,000, Carol.
8,000.
It's out of my price range, but I'm sure he's got some other more eligible customers lined up.
We can have a discussion after, you know what?
Maybe, one day. I can dream. Eric, it's been a pleasure.
Thank you. It's been a pleasure, too. Thanks to both of you.
Eric Martel is the CEO of the business business jet maker Bombardier. All right, we are getting closer to the closing bells. Just about 4 minutes to go here. Stocks down for a second straight day. Of course, the start of that two-day Fed meeting. A lot of great guests coming up in just a second.
Yeah, continue with us. We are Carol Master, Ramoon Bostic. We are live at Milken. I know, sorry. It's been a long day. This is Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 12 p.m. Eastern, right here on Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays at 9 p.m. Eastern Time, right here on Bloomberg. Context changes everything.
Why is Baltimore so important to you?
It's our state's largest city. And if your state's largest city is not thriving, your state can't thrive. And that is just a mathematical equation, because the only way this is going to be Maryland's decade is if it's Baltimore's time. And so that's why we did focus on things like being able to extend the Orioles lease and make sure the Orioles could be here for 30 years. It's the reason we focus on things like the Preakness and keeping the Preakness in Maryland for generations to come, while we've invested in the convention center. The reason we focused on housing and getting rid of the vacant housing. The reason we focused on violent crime. And now Baltimore is having amongst the most precipitous drop of anywhere in the country when it comes to homicides and non-fatal shootings and carjackings and auto thefts. So if you can have Baltimore thriving, your state is going to thrive.
So if somebody's watching this and they're not from Maryland, but they want to know a little bit about Maryland, what would you encapsulate in a paragraph or two about what people should know about the state of Maryland?
I would say Maryland really is American miniature. You tell me what you want to do. And no matter where you're standing in the state of Maryland, I can tell you where to have a world-class experience within 2 hours. We're the home of innovation. We're the home of Johns Hopkins University, the home of the NSA, the home of NIST. We have so much to offer in the state of Maryland, and I think it's one of the reasons that people are so excited about the growth trajectory we're on.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
The dollar as a reserve currency, there's no alternative right now, but that doesn't mean there can't be. I think also when you look at tariffs, one aspect of how to get a better trade balance would be to have a weaker dollar.
Welcome back to our special coverage of the 28th Annual Milken Institute Global Conference here in the Beverly Hilton in California. I'm Romaine Bostic. That's Carol Master. It's already been a great, I guess, 1.5 days. We still got a little more time here.
Incredible in terms of the conversation.
And I love just how broad the conversations are, right? I mean,
too.
Ultimately, this was basically a debt conference when it first started, leveraged debt, we should point out. And it's really expanded to so much more.
All over, from venture capital, talking about healthcare, talking about wellness, talking about longevity. I feel like we, kind of pull it all together.
We're going to hear from Magic Johnson, and a little bit later he's on stage with our very own Jason Kelly. So you get a nice cross-section of things that are going on in the world of finance, the world of entertainment, sports, and everything in between. Just a quick check on the markets as we get the closing bells in New York. Right across the screen for a second straight day. Fractional gains for most of the indices here, but an interesting setup heading into a big decision day for the Fed. A decision day where they might not do anything, but they're still going to have to say something, or at least they're going to be asked to say something. I doubt they'll say anything.
Listen, it's all about what Fed Chair Jay Powell has to say and what comes up in that conference, that press conference. So 24 hours from now, we're going to be all over it.
You see the numbers on your screen, a percent loss for the Dow Jones Industrial Average. Similar declines that you're seeing in the S&P, the NASDAQ, as well as the Russell 2000. Your big decliner on the day, the big laggard, that's actually Dow Transports, down about 2.3%.
All right, well, the world's biggest investors, as you know, converging here at the Milken Conference with tariff uncertainty and market volatility really top of mind. You've heard that in so many of our conversations. Joining us right now to talk about it is Matt Gibson. He's Global Head of the Client Solutions Group at Goldman Sachs Asset Management. So nice to have you here with us.
It's great to be here. I'll have to watch Magic Johnson's session soon. That sounds more fun.
Hey! Tell us a little bit about your clients. Are they having fun right now, or what are you hearing in terms of feedback? What kind of conversations are they having with you?
The clients are having fun. They're obviously observing the markets. It's been 6 weeks of uncertainty. I think what they're really looking for is to get some additional certainty in the next month or two. This is an alternatives conference, and so our investors tend to be long-term in their thinking. And so I would say we haven't seen a big shift in how they tend to allocate to alternatives in the last 6 weeks. They're just monitoring the market. If this were to continue for another several months and the cone of uncertainty didn't narrow, then I could see them starting to make some different decisions than they otherwise would have made. But right now, I'd say what's happening is not causing any of our clients to accelerate deals. If anything, they're hitting the brakes just a little bit. But I think it's too soon to say that there's going to be a sea change in the way they allocate.
What is the thing that creates a sea change? Is it, the thing that we are talking so much about?
Yeah.
Is it tariffs and some kind of deal? Is it a bad deal? I mean, I am curious, if we just get resolution, is that a good thing?
I'd say it's three things. It's the tariffs. I think everybody's watching that to see how that plays out. And there's a good scenario there, which hopefully we're on that glide path for, and then there's worse scenarios. But also watching rates and inflation. I heard you mention right before I started what the Fed does tomorrow and the interplay and the challenge they have between growth and inflation. And so that has import for deals and so forth. But the biggest thing out there right now is the tariff discussions that are taking place. And there's a hope, I think, around the world for our clients that gets to a better place soon.
Do you share that hope? Because there's been a lot of discussion about this idea that even if we do start to see meaningful movement on trade deals, that's not something you just do in like 30 or 60 days or how much time we have left. Typically, a trade deal is like a year-long or even multi-year process. So does that mean that the uncertainty lingers until we actually see them sign a piece of paper?
It's a great question. Yeah. I think what you'll see is almost some term sheets done in trade deals with other countries that are more high level. They'll have to be ironed out over the course of a year, but it will provide a template to the market to look at what the other deals might look like that get signed up. And I think, of course, the cone of uncertainty I mentioned earlier won't be totally closed until those deals are done, to your point. But I think if you can get 4 or 5 of these done, the world can look at them and say, okay, if we did this with X country, it probably looks like Y with that country. And I think that'll relieve a lot of concern that's out there.
I am curious about the recent market turmoil and whether that has generated new interest from new clients or potential new clients in private assets, alternative assets, real assets, et cetera.
Well, what you see is there are certain assets in a lower growth environment or in a high volume environment that might lend themselves on the private side to having clients being interested. So secondaries, you might have heard some of your clients mention those. In periods of lower growth or uncertainty or lack of liquidity, secondaries do really well. We've got a big business there. And so we're hearing a lot of questions from clients on that. Private credit comes up in every meeting that we have here at the conference, and there's certain slivers of the private credit market that would do quite well in an area of lower growth or uncertainty. And so nobody's really changing their allocation policy yet because it's only been 6 weeks. But the question we get a lot is, if this were to continue for the next 2 or 3 years, what do you think would do well? In that environment. And so those are the conversations we're having.
I kind of chuckle. He said it's only 6 weeks. It felt like 6 years, right?
It does.
But he's right. It's only been 6 weeks.
We've lost the concept of time, no doubt about it. You mentioned the secondaries market. I'm really kind of intrigued by that. How much is it growing, especially in this environment where it does feel like there are situations increasingly where that market needs to be tapped to kind of help a company keep going?
What's really interesting that's happening is, for a long time, the deal environment has been a little slower than it was before. And the return of capital for general partners like ourselves to their LPs has been slower than it normally is.
Right.
And so our clients are looking for ways to get liquidity for their existing private equity investments, for example. One way for them to do that is through the secondaries market. And so if you look forward and you assume the next year might be a little slower in terms of M&A activity, secondaries could step in and really fill that hole and provide liquidity. And so that's why we're all talking about it so much.
So the growth that you're seeing?
We're going to see the secondaries market continue to grow.
I would say, the private credit market is probably growing the fastest.
Okay.
That one's probably got the most innovation. I think if the world continues the way it's going, we're going to see real growth in secondaries as well.
You mentioned before slivers of the private credit market that are kind of in this environment, particularly doing well. How much can you drill down with us to talk about
Sure. So the private credit market has a lot of different elements to it. I mean, some of the questions that we're getting here at the conference include talk about investment grade private credit. So a lot of our clients have very big liquid fixed income books. And the question they're asking themselves is, should I take 10% of that liquid fixed income book and put it in private credit where I can get a little bit more of a yield and not give up on the liquidity quite as much as well, because it's a smaller segment of it. So we're talking to clients a lot about investment grade private credit. ABF, asset-backed finance, which I'm sure you're aware of, is a huge and growing, burgeoning market. We're having a lot of conversations about that. In a slower deal environment world, where clients are trying to sell the company, let's say, and they can't get it done, but they need to keep financing themselves, hybrid credit could be a good solution to provide them with financing without necessarily diluting their investment, allow them to fight for another day, improve operations, potentially sell the company later. So hybrid debt equity solutions we think are a good product right now as well.
It's pretty amazing. I just got to say, the amount of levers, right, for companies that are out there that need to kind of extend.
Right.
Yeah,
That's
fascinating.
Right. All right, I think we got to go. Matt, really appreciate it.
Yeah.
Matt Gibson is Global Head of the Client Solutions Group over at Goldman Sachs Asset Management. And Carol, I think we do have some breaking news on earnings that we do have to get to. I'm going to start out first, of course, with Rivian. That is the EV automotive maker. The shares have been oscillating between gains and losses all day long here. And now in the aftermarket session, no different. Revenue in the quarter coming in above estimates at about $1.24 billion. The street on average was looking for about $981 million. Cash and cash equivalents below estimates, $4.69 billion. But for the full year, the company does say that it is going to stand by some of its previous outlook ranges for adjusted EBITDA. That is a loss, but still standing by that previous forecast. But it does say deliveries, Carol, will be slightly lower than expected in the 40 to 46,000 range.
Yeah, we also have Wynn coming out with their earnings as well, and they are reporting, let me just pull it up here, having a little slowdown in my internet. Wynn Resorts first quarter adjusted EPS missing estimates, so we're seeing that number just cross the Bloomberg as well. So a few more earnings coming out, not surprising to see. And I guess what we really want to care about is what they have to say when it comes to their outlook. All right, we're still waiting for earnings out of AMD. We should point out Electronic Arts is out as well. Those beat on both the top and the bottom line. Our special coverage here at Milken continues, and we want to go down now to the stage, the big stage, where our very own Jason Kelly. He's going to leave us now.
He's leaving us. Our thanks to Matt Gibson. Down to the main stage with Alice Rodriguez, Jason Kelly, and Magic Johnson.
And I said, Lon, can I get 30 minutes with the guy? And I'm thinking, like, yeah, maybe in a couple of years. He's like, hey, how's tomorrow night? I'm like, bet. I'm there. So we sat in a room. It was supposed to be 30 minutes. He comes back. He goes, I got to make a quick call. And he comes back, he goes, we got a little bit more time. So that led to almost a 3-hour dinner where I have like 9 pages of notes. And there's no question in my mind that how Dr. Buss impacted Magic, Irvin has impacted me. And without that dinner, because here's a man of color, here's a guy that was a Hall of Fame basketball player, he comes from humble beginnings, all things that I can relate with. And I said, if Magic can do it, why can't I? I certainly wouldn't have A-Rod Corp today because he gave me the blueprint of how he built Magic Johnson Enterprises. And we've had this beautiful relationship that I just admire him so much, and he's been so good to me. As a matter of fact, my mom texted me the other night. She goes, call me is important. I go, Mom, we just won. I'm in LA. It's like 2 in the morning back home in Miami. And she says, Irvin Johnson, I screenshot it. He tweeted about us. And I see my good friend A-Rod, So anyways, I wouldn't own a team without Magic. I wouldn't have A-Rod Corp without Irvin. And I just want to say thank you. And I wanted to share that story with you.
No, thank you.
And so let me ask you, we love Alex.
Right.
Why'd you take that meeting? Like, what did you see in him back then? And what do you remember saying to him?
Well, the greatness of him as an athlete, but also too the way he carried himself, not just on the field but off the field. And then when athletes are thirsty for the knowledge, and they show up on time, ask a lot of questions, that really impressed me with Alex. And I knew that he was serious about, while he was playing, he was getting himself ready for the boardroom. And so it's the same thing for me, right? I was getting myself ready, taking all those meetings with Dr. Buss to get ready for life after basketball. And when I see a young athlete, and especially when you're great at something, right, then he understands the discipline, the work ethic it's going to take to become not only great as a baseball player, but that same mindset and attitude, he had to take it in terms of learning to become a great businessman. And so I'm so impressed. I'm so happy for him because now what I gave him, he's given to others, right? We always still got to pass it to other athletes and other people of color, not just of color, but whoever wants the knowledge, come get it. So it's a blessing to see him and to be on this stage with him today and see where we both are, right? Yeah. We both have grown so much from that meeting, and where I am today and where I was then is I'm in a completely different place today.
Well, let's talk about that, because what you have done over the course of the last 30, 40 years is a series of unbelievable deals. And one of the most interesting things, and Alex and I talk about this all the time, is your movement to ownership. Mm-hmm. You have a partner, Mark Ein, here in the front row with the Washington Commanders. Yep. We spent some time with your partner, Josh Harris, last week in Miami. That's a seminal deal for the NFL. Right. I would argue it's a seminal deal for you. Would you agree? And how do you put that in the context of your deal making?
No, it's the greatest deal I've ever done. I mean, listen, first as a kid, I'm already a football fan. I played football, but I knew I was better at basketball, so I gave it up in high school to concentrate on basketball. But to know that I've been a big fan of the NFL, not knowing that a man of color could actually become an owner in the NFL, but I had Josh Harris.
All right, everybody, you are listening to basketball legend Magic Johnson up on the big stage here at Milk in Beverly Hills, sitting down with Bloomberg, Alex Rodriguez, I should say, of the deal, Alex Rodriguez, and Bloomberg's Jason Kelly. They do this great...
You know Alex Rodriguez is famous, right? play a little ball.
Is this like just because I'm a girl, you think I don't know sports?
Yankees. Aren't you a New Yorker? I thought you...
I grew up watching the Yankees with my dad, the Giants with my dad, four brothers. I know the difference between
I know you know more about sports than I do.
Innings and quarters and all that good stuff.
All right, good. Well, I like sports.
I thought,
Yeah, all right. Anyway, that looked like a pretty good interview.
Actually,
and it was great too because and the thing is, I mean, and people should really listen to it because he talks a lot about his entrepreneurial spirit. Even back when he was first starting out his career in the NBA, that was always a goal of his. And you look at the success that he's had since he left the NBA, which probably is more notable than the time in the NBA.
Which is kind of fascinating to even say that, but there's some brilliant, business moves and so anyway, if you missed any of that conversation, be sure to check out The Deal with Jason Kelly and of course
Alex Rodriguez
to Magic Johnson. He's funny.
Did you know my wire was showing? Were you not going to tell me?
He's really funny. No, I'm not going to tell you. Hey, coming up, everybody, we've got the CEO of Guardant Health about their mission to improve outcomes. We're going to talk a little bit about cancer testing. That's coming up.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything. Tomorrow, the Fed decides.
It is the central banker's dilemma. Downside risk to growth, upside risk to inflation.
They are wait.
This is a serious moment. I do not think the Fed can just sit on the side.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
They're expecting stagflationary-like environment.
They are going to be on hold until they have hard evidence one way or another.
Bloomberg surveillance, the Fed decides, starting at 1:30 p.m. Eastern.
Welcome back, everybody. We're live at the Milken Global Investment Conference. I'm Carol Master along with Romaine Bostic. Before we get to our next guest, don't forget, we are still in the middle of earnings, and AMD out with earnings, also their outlook. And let's go right to it, because that's what really investors care about. AMD seeing second quarter revenue, $7.1 billion to $7.7 billion, quite a range. The estimate is for $7.23 billion, and that probably explains that more than 5% pop that we are seeing in shares of AMD in the aftermarket.
Yeah, kind of interesting, too. I'm looking for any sort of commentary about any of the issues with export controls, of course, with the CapEx spending and the AI boom.
Absolutely.
Not finding it jumping out here, but overall, we're talking about the most recent quarter, a 36% jump in revenue, but the expectation amongst analysts is that run rate will start to come down a little bit through the rest of the year.
Yeah, interesting. We should just point out, too, in terms of first quarter, operating margin a little light, operating income pretty much in line, a little bit better, and looking at first quarter revenue, came in better than expected, and first quarter adjusted EPS, 2 pennies better than expected, and CapEx, something we keep an eye on, that too was larger than what the street was expecting. Again, the stock up almost 6% in the aftermarket. Hey, when you think about stocks that have really been on a tear this year, you want to hear about this one. Guardant Health, their stock, first of all, jumped 11% intraday. That was just last Thursday after the diagnostic test maker boosted its revenue forecast for the full year. Firm also reported first quarter sales that topped expectations. The stock is up about 37% year to date, and the company recently announced a strategic collaboration with Pfizer to develop new cancer therapies. It is something that Guardant CEO is talking about here at Milken. Joining us right now is Helmy Eltoukhy. He is the co-founder, chairman, and CEO of the $5.4 billion market cap biotech company. We were talking about Guardant Health. So good to have you here with us. Quite a year for you guys. Investors definitely like what you're up to. You can see it in the share price. You boosted your revenue forecast for the year. What is driving growth at the company?
Yeah, we're really firing on all cylinders this year. It's been this journey that we've had for 12 years, developing breakthrough technology where we use biochemistry, DNA sequencing, and AI to see disease much earlier than ever possible in a tube of blood. And so we do that in 3 parts of the business. We help advanced cancer patients, stage 3, stage 4 cancer patients, essentially get matched to precision treatments without needing a biopsy, with just a simple blood draw. So we now test something like 25 to 30% of all U.S. cancer patients. That has been driving a lot of our revenue today. That's been on fire.
How accurate is that relative to an actual biopsy?
It's very accurate. It's FDA approved. It's covered
What's very?
99%. So
Okay,
it's
wow.
really high. It's very high specificity. If you see it in our blood test, it's there. And then we have the other side of the business that's just launching, which is early detection. That's obviously the sort of exciting sort of thing that people have been waiting for many years. And we just got FDA approval last year for a test that can detect colorectal cancer with a simple blood test. For those individuals who don't want to get a colonoscopy or a stool test, this presents an amazing new option for them to be able to get screened.
I think it's kind of fascinating. We all, unfortunately, have people in our lives, friends, colleagues, family members, where cancer has touched them. And I'm just curious about what you are seeing when it comes to cancer diagnostics, the business of how it is evolving, how it is changing, because that can be super complicated, super difficult, but I'm just curious about what you are seeing.
Yeah, so one of the challenging things about cancer I mean, ever since, Nixon sort of declared war on cancer in 1972, is the fact that we've always been one step behind. It's growing somewhere in the body. You can't see it. You don't know where it is.
Early detection is so important.
Exactly. And the ability to see it in blood. So a lot of we work with almost 200 pharma companies because we can actually see how it's evolving, changing. You think about COVID, how it's always changing. Cancer is exactly the same way. So we're able to take one step ahead of it. Not just early detection, but allow our pharma partners to develop new drugs which are much more accurate as well.
How does that fit into the whole debate about healthcare costs? And particularly when we talk about big diseases like cancer, which are incredibly costly to treat.
No, this is something we've founded the company on, is that I believe new technologies can lower cost and improve outcomes. And I think this is what's been exciting is that, the U.S. spends $15,000 per individual in terms of GDP, or $5 trillion per year. We're 2x more than any other developed nation in terms of healthcare costs, and we're seeing outcomes that are not as good. We're about the same as Vietnam. So there's so much opportunity with these new technologies to essentially detect disease earlier, where it's cheaper to cure, and you get better outcomes. We just deployed this technology in England, in the UK, and they're very cost conscious. We saw that once they deployed our technology for screening of all lung cancer patients, we are able to improve outcomes and lower the cost to the NHS by millions of pounds per year. So there's proof there. This is not hypothetical.
Do you see more of an effort, not only here in the U.S., but in other developed countries as well, to take a more proactive approach to healthcare, meaning much more of a focus on prevention rather than just waiting for the diagnosis and, of course, the cost to treat?
Yeah, this is what I think has been very pleasant to hear from the new administration, Dr. Oz and RFK Jr., in the sense that they're very focused on prevention. The problem in healthcare is that we don't measure and we cut 3 times. We should just measure twice and cut once, and that's where we come into the picture. So we're helping, developing countries in terms of detecting cancer earlier, where it's cheaper, where there's more access, and we can do that in the U.S. as well.
But just on a personal level, too, and this gets back to the accuracy. I went through my own battle with cancer. I went through a barrage of tests over several months before anyone actually was able to tell me exactly what I had. And using one of Guardant's products, how much does that speed up the process? Because if I get a test and it shows me there's a red flag in it, do I still have to go to an actual doctor and go through another battery of tests?
Yeah, so I'll give you an example. What happened in the UK when we deployed our technology for lung cancer patients? They were waiting 120 days, 4 months to get onto treatment with biopsies and so on. With our technology, we short-circuited that to 2 weeks. And that's because you're obviating the need for interventional radiologists, pathologists, all these, sort of army of medical staff to be in the picture. Okay. If you can just do that with a simple blood test, you can get to the sort of end result very quickly.
So less intensive, not as much of the damage to the body to figure it out.
And
as
just
I said,
faster.
we all have people like in our lives where this has impacted us. I think in my family, I had a mother who passed away from pancreatic. I have my husband's side of the family who's seen pancreatic. That is a cancer that you don't detect it often until it's too late. So can every cancer have an early detection blood test? Can you guys ultimately, is that the goal? Can we get there?
No, you're music to my ears. So the same test that detects colorectal cancer today, we just presented data at AACR, the American Association of Cancer Research, on 10 other cancers, and pancreatic was one of them. We're seeing amazing sensitivity, very high early stage sensitivity for liver cancer, stomach cancer, throat cancer, pancreatic cancer, lung cancer. And so this is just a matter of time. It's essentially just turning software on the existing test to be able to detect those additional cancers.
I want to ask you just about and I know you're not really treating, but when you talk about leveraging AI in diagnosis, how is that also being applied to making the treatments more efficient and hopefully less costly?
The challenge right now is the treatments are very coarse. It's sort of one size fits all, but every cancer is very different. And so the way we look at cancer today is like black and white television. It's very coarse and so on. Mm-hmm. With the technology we have, where we're looking at billions of data points per disease, we can see the exact subtype, like 8K resolution of that disease. And so if you know this person is subtype A, this person's subtype B, and this person's subtype C, you can develop drugs that are much more targeted. But if you don't know the subtypes, you're driving blind.
All right. Well, a fascinating topic, and obviously your company is right in the middle of it. Helmy El-Touki is the CEO of Guardant Health. All right, a lot more coming up here on the Milken stage. Carol, we're going to sit down in just a few minutes with Ken Kinsella. Of course, he is the president and CEO of Churchill Asset Management. And I like him because he's like one of the OGs. I don't know if he was at the original Milken, but he might have been.
I think he was. He knows Michael Milken.
Oh, there he is. He's telling me off stage he was. So maybe we'll just have him regale us with stories about his Drexel days, or we can ask him, I don't know, about the economy and markets and anything else.
I love talking about the old days with him. All right, everybody, stick around. We are live at Milken. Carol Master, Romaine Bostick, and this is Bloomberg.
You can have a baby anywhere you want. It's the environment and that care. That is what matters most.
Our investigation found some of the worst cases of harm were surfacing.
मुझे क्या पता कि भला के चक्कर में मेरा ही बुरा हो जाएगा।
I never thought I would be vulnerable to a scam. This ruined me, and I didn't have any real good explanation for it.
Wildlife trafficking is almost always driven by greed.
Once you start focusing on money, you lose sight of what is best. That's where things go wrong.
In case you missed it, on the Pulse.
I think that the tariffs actually represent more of a disinflationary risk than an inflationary risk. You think of, for example, products coming from Asia looking for a market, them offering lower prices to find access to the market, but actually you could get trade diversion from the EU because the UK has lower tariffs. It all depends on how much substitution there really is.
Don't miss the Pulse, live every weekday.
What's the best thing and what's the worst thing about trying to put money to work in this market?
Technically, we're an endowment, but we use the best of the endowment model and the hedge fund model so we can react very quickly. And I think we're very good, I would argue probably one of the best in the world at connecting the dots across asset classes. And from our perspective right now, the volatility is great. I think market structure is still challenged in that liquidity at moments in time when there's a lot of volatility is challenging. So you can see a great trade, but sometimes buying as much of it as you want is easier said than done.
Do you have a favorite trade right now?
So we are tactically, at the end of last year, we bought call spreads on Hong Kong equity indexes. And I continue to like that trade, so we're holding that position. And again, when you see kind of the micro and macroeconomic data coming out of the US and you see the data in China, I think you will see a tactical deal out of economic necessity between China and the US. And I think when you look at investors generally, they've left China for dead. So I think there's going to be money forced into that market.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Welcome back, everybody, to our live coverage of the Milken Global Investment Conference. I'm Carol Master, along with Romaine Bostick. Private credit, yeah, we tend to talk about that a lot here at Milken. It's grown rapidly in recent years to become a $1.6 trillion industry. That expansion and relative lack of regulation, though, has fueled some concerns about the quality of private credit loans if the economy deteriorates, which begs the question, amid all the talk around a possible U.S. recession, or could it be stagflation, might we be getting there? Ken Kinsella has invested in numerous credit and economic cycles. He's laughing at me right now. He is the president and CEO of the global private debt manager, Churchill Asset Management. The long its sister cousin company, Ortman Asset Management, comprises Nubian private capital. I'm trying to get through it. $78 billion.
That's a long intro.
Can't you just have one name? $78 billion private capital. You are the OG when it comes to private capital. You were laughing at the introduction. Why? Because you don't think?
No, it's very simple. It's Churchill, right?
Oh,
That's what people know me as, Mr. Churchill, so I'll take that. Yeah.
Hey, listen, I think it was roughly, let me just look, 2 years ago, you talked about the golden era of private credit. We always bring it up right now. Is it still golden? Is the shine off a little bit right now? How would you describe it?
I would say still very much so. I mean, if you think about the dynamics today, we were on a roll, right? Third quarter, fourth quarter, first quarter, activity coming back, interest rates stabilizing, everything looked fantastic. We had a record quarter of deployment, capital raising, everything going great. And then, of course, we had Liberation Day, right? But what's interesting about Liberation Day is that it's actually creating a further opportunity for private credit. But if you think about the dynamics, when the public markets close and go offline, that creates opportunity in private credit. And unlike the GFC, where there really wasn't a private credit market to step in, there was private equity, but not a lot of private credit. Today there is. I mean, if you look at the largest managers like ourselves, we have $13 billion of dry powder. Very much open for business, very interested in providing that capital. Now, we haven't yet seen a widening of spreads in the private credit market yet. I know the BSL market is basically closed and secondary spreads have widened out a bit. But I think what you're going to see if this environment continues, and I suspect it will, at least for a short period of time, is that private credit will take advantage of those opportunities.
I'm just curious. So, I mean, what do spreads look like in the direct lending space? And I know it's probably very specific to each individual company and scenario, but I assume those had to have widened out.
You know, interestingly, Romaine, they have not at this point, but what has narrowed in are the companies that are getting financed, right? So A-plus credits with little to no tariff impact, yes, still very much being financed. In fact, we didn't have a single deal that, you know, as we went from March to April, that actually went on hold or was otherwise pulled back. So I would say spreads have not yet widened in private credit, but the kinds of deals that can get done have narrowed, right? Higher quality gets done, tariff impacted, not really.
All right, but the uncertainty of the past month maybe increases the need for some firms, right?
Yes.
To reach out to someone like you guys.
Yes.
So were you busy post April 2nd?
We've been very busy. In fact, we've been
busier, like as a result of what happened with the tariff news?
What we've seen are larger companies that would have gone to the syndicated loan market or the BSL market. That market's essentially closed. Yeah. So what we're seeing is they're coming to private credit managers and saying, look, can we club you guys up? Can we get 2 or 3 direct lenders to do $1 billion financing?
So it's bigger companies.
Somewhat larger companies, which is typically what happens. And overall, what we should see is generally wider spreads. Today, you asked the question, where are we today? Probably SOFR 500 or so. Okay. Things really haven't widened out that much, but I think you will see spreads widen out. I think you'll see leverage come in a bit. And, of course, you'll see our good friend, the Covenant, come back in vogue, which we like to see.
What do those look like?
In our world, we see them, right? Yeah. But I would say as a general matter, you know, in the liquid markets, not so much. So I think it opens up larger deals. It opens up deal flow that enables us to step in. You know, it's interesting. If you look at the GFC, there was plenty of private equity, but the banks weren't lending, and there was no direct lending. Today, tremendous amount of dry powder in direct lending, still a lot of dry powder in private equity. So I think things will normalize. And frankly, from my perspective, I don't think we're going to see an extended period of this tariff dynamic. I would expect that it'll play out in a reasonable period of time, and hopefully shorter rather than longer. And obviously, the longer it goes, you know, the worse it could be.
I'm curious, when you say that then, if you're looking for new opportunities, I mean, a lot of people have said, okay, we're only looking for companies that, you know, domestic companies or companies that don't have a lot of international exposure or tariff exposure. Is there an argument to be made that maybe you should be looking at those names, assuming that their valuations might have come down because of the tariff pressure?
Yeah, well, I would say maybe, but not for us. Okay. I mean, I would say, here's an interesting stat. 92% of our borrowers today, we have about 600 companies in our portfolio, 92%, no impact, no tariff impact at all. Wow. So private credit, by its nature, is mid-market U.S. companies that tend to be more domestic, that tend not to be as international as maybe some of the, you know, large cap businesses are. So in that
primarily
sense,
services businesses,
services, healthcare, software, you know, business services that tend to be more domestic.
But you're picky in terms of who you choose.
We're really picky.
I mean, that percentage is impressive, but I'm just saying, you're really careful with who you pick.
Yeah, no. And
I'm sorry, go ahead.
And as a general matter, within that, we tend to focus on those, you know, those sectors that are less impacted.
Real quickly, Ken, we're running out of time. I just have to ask you, though, going back to the origin of this conference, which you sort of chuckled, you were here, 1998, whenever that was here.
Yeah.
The evolution of this. Is this an evolution or is it just growth?
It's absolutely an evolution. Yeah. And I would tell you, it changed in a number of ways. Early days, it was more of a policy conference. It's retained that policy, which is great, and I think attracts a broader audience, but the investors are all here, right? And they're all looking to talk about their stories, and they're exchanging ideas with each other. I was saying earlier to both of you, some of the most interesting conversations I've had here have been the one-on-ones with other investors. Yeah. You know, we don't get to see each other very often, right? We're all on the road raising money, but we're all here, right? So it's an opportunity to share ideas, think about, okay, have we thought about different angles from an investment standpoint? So in that way, it's really evolved quite a bit.
All right, Ken, we have to leave it there. Always a great pleasure.
Wait, you don't want to have them share one of those deals, those ideas on the side?
I don't know. My producer's in my ear telling me I should have wrapped like 10 minutes ago. But
wait, you listen? You actually listen?
Sometimes I listen. Ken Kinsell, Churchill Asset Management, President and CEO. Let's toss it back to New York and Bonnie Quinn.
Thanks, Romaine. Yeah, because there have been some very interesting earnings out. AMD, not disappointing. That stock is up around about 5% now in the post-market. It came out with a strong forecast. Adjusted earnings in the previous quarter, 96 cents. That beat by 2 cents. CapEx forecast and so on beat. Although the adjusted operating margin was 24%, which was light of estimates, it does see that operating margin improving. Now, that could bode well for NVIDIA later in the month. We know that analysts and investors are looking for NVIDIA's margins to start improving towards the middle of the year. That's what NVIDIA has said. Now, in terms of other earnings, we have Rivian cutting its forecast and saying that tariffs will impact their business. The loss per share, 48 cents, with a tariff impact of about $3,000 per vehicle. Perhaps not as bad as anticipated. Shares only down about 0.75%. They have been oscillating in the post-market, but full-year deliveries are lower than it was anticipating, between 40 and 46,000, as opposed to the previous forecast of 51,000. Another headline for you, Weight Watchers International. It's filing a prepackaged Chapter 11C bankruptcy immediately. Shares down about 49%, as you might imagine, post-market. It had a loss of 91 cents per share, which was much better than last year's loss, but it's now in substantive talks with an ad hoc group of lenders, so that company in trouble, filing once again for bankruptcy. Overall, in the session, we had the S&P 500 down 0.75% for a second day of declines. The Nasdaq 100 was down 0.9%, and yields were lower to the tune of about 4 basis points across the curve. Now back to the Milken Global Institute and Carol Nasser.
All right, Bonnie, thank you so much. Well, according to Bloomberg NEF, New Energy Finance, the global carbon market is already substantial. It's valued at $800 billion in 2023 and projects, a potential for the market to grow significantly. We're talking about maybe $1 trillion annually by mid-century. This growth depends on factors like the resolution of credibility issues and the scaling of carbon removal and nature-based solutions. Carbon credits, by the way, one of the discussions going on here at Milken with Morris Olivia Albrecht. She's the CEO and founder of Artemeter, and she is also, I want to point out, prior to this, served as CEO at Aspiration, a climate finance and Oak Tree portfolio company offering sustainability solutions for consumers, businesses, and investors. Before that, she also spent a decade at PIMCO, most recently as head of ESG business strategy. I mean, you are just all in, it feels like, from a lot of different perspectives. How would you today, what's cool about Milken is the intersection of finance with everything in our world. So how would you describe the intersection of finance and climate right now?
Absolutely. Look, as you mentioned, the carbon markets really are that intersection of climate and capital markets. And we really believe that they can be part of the solution to help us decarbonize and transition the global economy to a low carbon economy with energy dominance that's focused on clean energy. So carbon markets are really at that epicenter. As you mentioned, it's almost $1 trillion today. This is not a small asset class. It is not a small market. But a lot of people focus their effort and energy on the voluntary markets, which today is $1.5 billion, so fraction of the total carbon marketplace. At Artemeter, we're carbon investment managers at our core. We're focused on applying capital market savvy and experience plus science and integrity to help create a solution to the amount of carbon that we have in the atmosphere, which is just fundamentally out of balance.
Is the interest still there? Because there's been a lot of talk about the U.S.'s commitment to climate change goals and the idea that if governments start to pull back from some of these goals, then there might be less incentive for investors to also to pursue those types of investments.
These are the exact topics that the market is wrestling with today. We need to see clear demand signals for carbon assets. In the compliance markets, which make up the bulk of the hundreds of billions of dollars of assets in this space, they're clear demand signals because they're obligatory. They're compliance markets where there's an obligation from those entities operating in those jurisdictions, like the California cap and trade system, for example. Where we haven't seen that same demand function is coming in the voluntary markets. And I like to kid, but it starts with the name. It's voluntary carbon markets. It's voluntary. What do we need to see? More compliance, regulated, required activity.
Well, good luck with that, because you have a president who has taken us away from the Paris Climate Agreement. So how do we get there?
Well, it's interesting. The first speaker at Milken on Monday morning was Scott Bessent, U.S. Secretary of Treasury, and he's talked about the idea of a carbon border adjustment mechanism to match the competitiveness and leveling the playing field for our U.S. companies here in the U.S. compared to the European CBAM that has an export. Anytime you export into the European markets, you're going to have to pay a carbon tax. Do you want to send, as a U.S. company, do you want to send your tax dollars to Brussels, or do you want to fund the government activity at the U.S. government? So I do think that there are parts of the U.S. administration today who are serious about carbon as being part of a tariff plan and program.
So do you think you'll see renewed interest? I mean, Bloomberg had a great story last week about how a lot of financial firms have actually scaled back their ESG departments, some sort of saying that they overhired, given where we are now. But is this just sort of kind of almost cyclical to a certain extent, and then at some point, I don't know if we're talking to you 2 years from now, it'll just be a totally different story?
I think that you're consistently hearing in sustainable finance, so carbon as being an offshoot of this concept of sustainable finance and sustainable investing. I think you've got clear kind of consensus among institutional investors that climate, carbon, other sustainability factors are just a core part of your research function. If you're not focusing on those factors and you're insuring homes in California, you're missing the boat. You're not doing your job right. So these factors are critical as part of the research function, absolutely. But I do think you're seeing a step back, particularly in the venture markets. I think you're starting to see real interest, deep interest in infrastructure, project finance, where you're starting to see the technology risk has passed, and now you need to deploy and scale. And I think you're seeing billions of dollars being deployed into infrastructure, project finance related activities.
All right, Olivia, there's still a lot more to go. Olivia Albrecht, she's the CEO and founder of Artemeter. All right, let's toss it back to Bonnie Quinn, who's keeping an eye on all the market-moving news. Bonnie.
Exactly, particularly the post-market earnings, Romaine. And we got good news for investors from AMD, Advanced Micro Devices, forecasting strong revenue for the current period. It says that's driven by demand for high-end computers, which of course capable of creating and running AI software. We're looking at this for a little bit of a nod to what NVIDIA might say towards the end of the month. And as you can see, shares are higher, up about 4.4%. They were up as much as 8% earlier in the post-market session. Now, margins are improving towards the middle of the year, according to AMD. The current margin at the moment, a little bit shy of what Wall Street was looking for at 24%, but it sees a second quarter adjusted gross margin of 43%, and that's inclusive of export charges. Now, on to other earnings. Rivian cut its revenue forecast, although revenue in the last quarter beat at $1.24 billion versus less than $1 billion for the estimate. Shares were oscillating. They are down about 0.75% because its full-year deliveries are going to be less than what it originally forecast. Now, between 40 and 46,000 vehicles. The forecast had been 51,000 deliveries, and it does say there'll be a tariff impact of about $3,000 per vehicle. And then another company filing for bankruptcy in this case, Weight Watchers, or WW International, a loss per share in the quarter of 91 cents. But the bigger news is that it's filing a prepackaged Chapter 11 bankruptcy imminently. Shares down 42% post-market. It says it's in substantive talks with an ad hoc group of lenders. Not the first time, of course, that that company has filed for bankruptcy or bankruptcy protection. In the regular session, we had the S&P 500 down for a second day by 0.75%, and the Nasdaq 100 down 0.9%. So we'll see what all of these earnings, plus of course the earnings before the bell tomorrow and the earnings after the bell, they all include Disney and many more companies, what that will bring. Back to the Milken Global Conference now, and Romain Bostic. Romain.
All right, we continue our coverage here with the focus now on technology and AI. And of course, with the promise of AI also brings risk. The technology fueling new and more efficient types of cyber attacks. So how do you fight AI-driven crime? Well, with more AI. Cybersecurity company Darktrace uses unsupervised machine learning techniques to build so-called patterns of life for your network, your computer, your phones, whatever. And then they use those patterns of life to detect abnormal
It's like you know what they're doing.
That's right. All right, well, let's talk to a person who really knows what this company is doing, because she's the CEO of Darktrace. Jill Popelka joins us right now from the Milken stage. Great to see you.
It's great to be with you.
You are at the center of the universe now, although a lot of people may not talk about it publicly. But every company, and for that matter, individuals as well, have much more of a renewed focus on protecting their computer systems and networks here. Are you seeing that actually translate into new business?
It is absolutely a hot topic. Today we serve over 10,000 customers. We're a little over $1 billion in revenue. We have three main products: network, email, and cloud. So we're protecting quite the coverage of your IT landscape.
Talk about this idea of patterns of life, right? So you're using this technology to sort of learn how I use my device or how I use my network. Right. If you see something that does not necessarily fit that pattern of life, what happens?
We run it against models. So we have a number of AI models. We actually used a multi-layered AI to evaluate, is this truly a threat? We can take a number of events, put those together, compare them to our models, and we can say, is that anomalous behavior compared to what your organization normally is doing? And so by recognizing anomalous behavior, we can categorize that as a threat and then prevent it from hurting you.
Jill, one of the things I think about is, right, AI gets smarter, machine learning, large language models, the more information that gets put into it. How does we make sure that, especially when it comes to cyber attacks, they're constantly figuring out new things to do? How does the AI that's going to help us prevent them or catch them keep ahead of that cycle when they're being so innovative and coming at us?
That's why Darktrace is such a unique and innovative solution, because we are very business-centric. So since we are learning your patterns of life, we're like your human immune system. We are going to understand when something foreign comes in that shouldn't be there, and not only detect it, but prevent it from harming you, prevent any data exfiltration, prevent an unknown actor from coming into your environment. That allows us to stay completely ahead of even novel threats. So we saw an increase of novel social engineering, about 135% increase the month after ChatGPT was launched. That means that, exactly as you mentioned, AI is encouraging threat actors to act more sophisticated, act with higher velocity. We can stay in front of that because we are using AI to combat it.
You've been your own deep fake, right? Like, that created a system. You started at a company, right? And one of the workers there got something that they thought was from you.
That's exactly right, Carol. It was in my first board meeting, too. I came out of my first early session in the board, and they said, Jill, there's been a deep fake of you. It's been sent to some of our employees, and they're asking for a response. Luckily, our employees are fairly astute when it comes to dealing with these things, so they knew that it wasn't me.
But they're getting more sophisticated. That's the point,
Very much.
Sorry.
Well, on that sophistication, though, also, there's been a lot of concern that a lot of attacks are originating from governments, or at least government-sponsored organizations. And I'm wondering if that makes your job harder, because you're not just going up against just your run-of-the-mill criminal. You're going up with governments that potentially have a ton of resources to try to, I guess, best your technology, if you will.
We really don't care where that attack originates, right? Since we are business-centric, since we're looking at your data, and it's a private language model really evaluating your data, doesn't matter where the threat comes from, we can prevent it. We can prevent it from hurting you.
Where are you seeing the most demand right now? Are there geographic differences? Are there sector industry differences?
You know, I think critical infrastructure will always be a place where we're going to see a lot of demand. Healthcare is really looking at how they protect their environments as well, healthcare and pharma. But I mean, I think what we're really focused on is that the whole world needs Darktrace, needs to understand how to protect themselves, and luckily we can serve strategic customers with forensic cloud investigation capabilities, and we can serve lower segments with a cyber AI analyst that allows you to really empower your SOC.
Really interesting stuff. Very, very cool stuff. Yeah, I'm glad you guys were on it because I'm a little nervous as what's to come. Jill Popelka, thank you so much. Really appreciate it. She's the Darktrace CEO joining us here at Milken. Thank you so much. I mean, I do think about dark deepfakes. Like, this is kind of the next wave. Yeah. And, you know, you think you're sophisticated, you think you can catch it, but they're getting smarter and sophisticated. And, you know, I do wonder about the impact in catching it all.
Yeah, and even like on a more pedestrian level, when you talk about things coming into your phone through text messages or emails and things like that. And I think about how more creative they've gotten.
Absolutely.
It used to be very easy to spot and know, okay, this is certainly spam. I don't need to click on it. Now it's, I don't know, it's a lot of it looks kind of official.
I feel like the spelling errors are gone. I can't tell you how many conversations. Well, you know that there used to be like the grammar was bad, the spelling errors, but how many conversations I'm having with my husband about it. Is that real? Is that something we need to look at?
Yeah.
All right, folks, day 2 of Milken. We are winding down. We're now joined by Bloomberg's very own Jason Kelly, who is just coming off a panel with basketball legend Magic Johnson. You saw some of it. Jason's here. Pretty cool conversation that you and Alex Rodriguez had with him.
Listen, Magic Johnson, one of one. I mean, just an unbelievable success, obviously on the court here in Los Angeles. But what he's built over the past 20, 30 years is unrivaled in terms of, you know, you think about insurance businesses, movie theaters, Starbucks partnership, and an owner of the Los Angeles Dodgers, and most importantly, we talked a lot about this, one of the big owners of the Washington Commanders, and he said that is his best deal of all time.
One thing that I managed to catch a little bit of your panel, and one interesting thing he talked about was how while he was playing in the NBA, he was reaching out to business leaders, including the owner of the Los Angeles Lakers, for advice on how to do this. And that was actually relatively novel back then. I know it's commonplace now, but back then that was relatively novel.
It was totally unique to him. You're exactly right. And he really leveraged that relationship with Jerry Buss, the longtime owner of the Lakers. Obviously, his daughter, Jeannie Buss, now the owner. And, you know, one of the really cool things about this conversation is my partner, Alex Rodriguez, on the deal, he was a mentee to Magic. He used Magic's playbook, and Alex said straight up he would not be the owner of a basketball team without Magic.
I'm confused. Was A-Rod not available for this interview?
Actually, what's funny is A-Rod had literally sprinted off stage because he's got a playoff game in Minnesota tonight after they beat the Lakers last round, and so we got into that a little bit too.
He said Romain Bostic, no way.
Yeah, he was like, listen, I can't compete with Romain Bostic. Why can I go on that set? I'm going to lose that handsome contest.
So listen, A-Rod and you guys talked to some really cool athletes about what they're doing. What is it you want to know from Magic Johnson? Like, a lot of it's been laid out at this point, but what did you want to know?
I wanted to know how he picked partners, what he thought his best deal was, and it is the Washington Commanders. And, you know, he said it was important as a man of color to be an owner of an NFL team. That was huge. And also, it is the biggest sport in all of the world. And so he wants to be a part of that.
What is the idea of what he wants to do next? I didn't hear that part. We know what he's invested in. Is he still active? I mean, is he still looking for new opportunities?
He's incredibly active. In fact, you know, we do this little rapid fire section at the end of our conversations, and we said, who's your dream deal-making partner? And he said, the next one. I mean, he is always on the hunt for new deals. And listen, he comes to a place like Milken to do deals. You know, I mean, he talked to the audience about the idea of like, I'm open for business. Here are my partners. And he is incredibly ambitious. One of the things he talked about, which both of you guys I think will find find interesting is he invested his own money, which he had a decent amount of from a highly successful career. But the key thing that he did is once he was successful doing that and he had a track record, then he went up to CalPERS and CalSTRS and said, I want some institutional money. Took him 3 years to get it. They gave him $50 million and they said, listen, if you make good on this and you give us some returns, there's a lot more where that came from. He looked at us and said, hundreds of millions more came in because I delivered.
That's amazing.
Yeah.
It's unbelievable. Your takeaway from Milken, you've been to a lot of them.
This was a big one. You know, my takeaway is that there were a lot of government officials here, a lot of people from the Trump administration, and who are really interacting a lot with the leading, leaders and thinkers in business and finance. That feels very deliberate. It feels like people are looking for safe spaces to figure out what's next. I had a conversation with Henry Kravis and George Roberts on stage yesterday. Henry talked about the uncertainty, and a lot of people have talked about that uncertainty. It feels like there's a real effort on the part of Mike Milken and others to bring some people together and really figure out a road ahead.
All right,
Really
Jason,
great stuff.
Yeah, Jason Kelly. He's our Bloomberg.
I like you a lot, but you know what? I think I like him.
I know. You and Jason go way back. That's all right. I'll be number two. I'll be number two. By the way, we should just point out, too, Jason just had really two of the best panels here at American with the founders of KKR on one day, and then, of course, the basketball legend, Irvin Magic Johnson, the next day. A lot more great stuff is coming up. Milken is not over. We'll be back tomorrow for our third day of coverage here. We're going to hear from a lot of people. Jason Thomas over at Carlisle, Amanda Lyman over at BlackRock, and also the Central Bank of Kenya governor. There's actually a lot going on. We haven't talked a whole lot about the African economy.
Talked a little bit about it, but there's so much more going on. Have a great and safe evening. We appreciate your time that you spend with us. I'm Carol Massar, along with Romaine Bostick.
Are you going out tonight?
I do like you.
Do you? Oh.
I do like you.
Okay, all right. I'm starting to like you. All right. We all love each other here. Carol Massar and Romaine Bostick live from our special coverage here at the Beverly Hilton. Thanks for watching. Bloomberg coverage continues with Balance of Power.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg. Earnings season is here.
Earnings season begins. Is corporate America in a good place?
Wall Street is bracing.
Bloomberg is first to break the numbers.
We got Delta, Constellation Brands.
The wave of big tech earnings.
We've seen a re-rating of earnings estimates.
I got to pay special attention to all this.
With the smartest insights.
Given the degree of uncertainty, you haven't really cut earnings estimates that much.
Anyone who says they have certainty on where the growth outlook is going, where earnings are going, is probably exaggerating.
Continuing coverage on Bloomberg.
In case you missed it on the opening trade.
The president is speaking to this part of our population that we know did not benefit from globalization. The IMF has been talking about those left behind for decades, and we haven't really seen anything to speak to that part of the population. That's who President Trump is speaking to. But we in Europe, we're seeing the same thing. We're just a few years behind. That part of the population who were left behind are voting, they're speaking. And this is going to unpick a lot of the fabric of the economy that we have seen for the last 20 years. So for me as an investor, it's really thinking about, right, if we had 20 years of globalization that created winners and losers, who were they? And if this is going into reverse, maybe the past losers will be the winners, and maybe the past winners will be the losers.
Don't miss the opening trade, live every weekday.
Why is Baltimore so important to you?
It's our state's largest city. And if your state's largest city is not thriving, your state can't thrive. And that is just a mathematical equation, because the only way this is going to be Maryland's decade is if it's Baltimore's time. And so that's why we did focus on things like being able to extend the Orioles lease and make sure the Orioles could be here for 30 years. It's the reason we focus on things like the Preakness and keeping the Preakness in Maryland for generations to come, while we've invested in the convention center. The reason we focused on housing and getting rid of the vacant housing. The reason we focused on violent crime. And now Baltimore is having amongst the most precipitous drop of anywhere in the country when it comes to homicides and non-fatal shootings and carjackings and auto thefts. So if you can have Baltimore thriving, your state is going to thrive.
So if somebody's watching this and they're not from Maryland, but they want to know a little bit about Maryland, what would you encapsulate in a paragraph or two about what people should know about the state of Maryland?
I would say Maryland really is American miniature. You tell me what you want to do. And no matter where you're standing in the state of Maryland, I can tell you where to have a world-class experience within 2 hours. We're the home of innovation. We're the home of Johns Hopkins University, the home of the NSA, the home of NIST. We have so much to offer in the state of Maryland, and I think it's one of the reasons that people are so excited about the growth trajectory we're on.
The top names at the Fed are on Bloomberg.
I'm not going to overreact to any increase in inflation that I think is attributable to the tariffs. But if I see a significant drop in the labor market, then I'd be ready to go. I wouldn't be sitting here waiting to determine whether the inflation is transitory or not. It's time to worry about the real side of the economy. I would.
Politics to the world of business. This is Balance of Power. Live from Washington, D.C.
From Bloomberg's Washington, D.C. studios to our TV and radio audiences worldwide, welcome to Balance of Power. Alongside Julie Fine, I'm David Gura.
Tonight, the high-pressure Oval Office meeting to reset a key alliance.
Having met with the owners of Canada over the course of the campaign last several months, it's not for sale, won't be for sale ever, but the opportunity is in the partnership and what we can build together.
The D.C. encounter a week in the making after Mark Carney won his national election by promising voters he can guide Canada through the economic turmoil of the trade war kicked off by President Trump. Reporting and analysis coming up.
Plus, the Treasury Secretary's congressional grilling and the true state of those White House-China trade talks.
We are currently negotiating with 17 of those trading partners. China, we have not engaged in negotiations with as of yet. Many of our trading partners have approached us with very good offers, and we are in the process of renegotiating those.
What we learned from Secretary Scott Bessent today as he testified pushing the president's budget before lawmakers amid increasing global trade tensions and a ticking debt limit clock on the eve of the Federal Reserve's meeting. All the developments up ahead when Budget Committee Chairman Representative Jody Arrington and Texas Senator John Cornyn join us here on Balance of Power.
Transportation Secretary Sean Duffy tells Americans it is safe to fly after major delays at one of the country's